Hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are starting with our 9 past papers compilation, including the latest paper, that is Jan 2026 CA Final Direct Tax paper in full English for our dearest students of South India mainly. So earlier we have also completed 9 RTPs in full English. I hope you all have enjoyed that. If you have enjoyed, again I would like to say, please comment below on the video and also put timestamp on whatever point you find important, so that when you refer for the next time, it is very important for you to identify it very easily. Okay. So today we are going to start with our past paper compilations. 9 past papers compilations we are going to do, and after that, after a few days, we are going to also do 8 MTP. So that will make total 26 papers. So the very first paper over here is May 2022 paper. Let's start with May 2022 paper. The very first question is on total income. I've already told you that whenever you do a total income question, you should always read the last line first. They have asked to compute total income and tax payable, and they have asked us to opt for 115BAA. So as for 115BAA, you have to compute the total income of the assessee and the tax payable of the assessee. Okay. We are not supposed to do the normal provision. Only 115BAA is relevant over here. Now, the very first question over here is, the very first line is, assessee is a manufacturer. The profit of the assessee is 850 lakhs. And then they have given us some adjustments which are debited and credited to P&L account. The very first adjustment is a routine adjustment of depreciation, which you will add back because it is as per Companies Act. The second adjustment says that employer contribution of 18 lakh and employee contribution of 18 lakh of March 26, that is of the last month, is paid on 20th of May 2026. Now we all know that the employer contribution you can pay up to the due date of filing of return as per 43B. But the employee contribution has to be paid by 15th of the following month. So here you are making a mistake. What mistake you are making? Employer contribution is correct, but employee contribution is late. Therefore, employee contribution has to be paid by 15th of the following month. In this case, it has to be paid by 15th of April because the contribution is pertaining to March. But you have paid in May. Therefore, employee contribution will be disallowed. Employer contribution will be allowed as per 43B. I hope it is clear to all of you. Next one is the GST penalty. GST penalty is penal in nature, therefore it is disallowed. It is for breaking a law, therefore it is disallowed. GST interest is considered to be compensatory in nature. Interest on GST late payment is allowed as a deduction. Interest on income tax late payment is not allowed as a deduction. Next one, you are giving some 10 lakh rupees on notified skill development project under 80CCD, not allowed under 115BAA. 115BAA does not allow 80CCD. Next one, you have some old machinery which is destructed due to fire, on which there is a loss of 20 lakhs. So very simple, add back this loss to PGBP. This will not be allowed as a PGBP deduction because it's a capital loss. So add back this loss and adjust in the WDV of the asset, but WDV of the asset is not given to us. So ignore that. Okay. Because the WDV of the asset is not given to us. So ignore that. If they would have given the WDV of the asset, we would have adjusted. Similarly, there is a scrap of 5 lakh rupees which you would have credited to P&L, reduced from the P&L account and adjust in the WDV, but WDV of the asset is not given to us, so ignore it. So leave it. So what is your ultimate treatment? Loss you will add back and scrap you will reduce. Then you are receiving some dividend from foreign company of 15 lakh rupees. So reduce from here and show under IFRS. Now, to earn this dividend, you have incurred an expense of 50,000 rupees. Now, we all know that from dividend, you can get deduction of only one expense, that is interest expense. No other deduction is allowed from dividend income. That too up to 20% of the gross dividend. That too only to residents, not to non-residents. Now, this 50,000 incurred by the assessee, I don't know whether this is interest or not. If you assume interest, then you can claim as a deduction. If you assume not as an interest, then you cannot claim as a deduction. So what we are assuming, we are not assuming it to be interest. So what is the ultimate treatment? Add back this 50,000, that's it. So what is the ultimate treatment of this entire adjustment F? For dividend received 15 lakh, reduce from PGBP, show under IFRS. And for this expenditure, add back, do not claim deduction because we are assuming it to be not an interest. If it is not an interest, then it is not allowed as a deduction. Next is a very routine adjustment. 15 lakh profit is generated when a 100% holding subsidiary sells assets to each other and the recipient company is an Indian company, then it is exempt under capital gains under section 47. Provided the relation should be 100% holding subsidiary and the recipient company should be an Indian company. So in this case, this 15 lakhs will be reduced from PGBP and it will be exempt under section 47. You can write a note under capital gains, it is exempt. Next, some additional information is there. Normal depreciation of 92 lakhs, you can claim as a deduction normal depreciation. Then one more information is there. In last year, 24-25, you have purchased a new machinery on 10th of January for 20 lakhs. Therefore, in the last year, you would have taken 50% additional depreciation because the asset was put to use last year for less than 180 days. Therefore, last year you would have taken 50% additional depreciation. Can I claim balance additional depreciation of 50% in the current year? Yes, you can. But you will not be able to. Why? Because you are following 115BAA. Because you are following 115BAA, the balance additional depreciation cannot be allowed to you in the current year. I hope it is clear to all of you. Next one is also pertaining to last year. Last year, you have done some repair to your factory building and you have credited an amount of 7 lakh rupees to contractor's account. You should have deducted TDS and paid TDS. But you have deducted the TDS, but you have paid the TDS late. That is on 31st December 2025. You should have paid before the due date of filing of return of last year, but you have been late. So what will happen? In this case, it's very simple. 30% of 7 lakh would have been disallowed last year because it was not paid on time. So in the current year, because you have paid now in the current year, it will be allowed in the current year. 30% of 7 lakh comes to 2.1 lakh. 2.1 lakh you can claim as a deduction in the current year. And last but not least, on 15th of May 2026, the assessee, that is the company, declared dividend of 20 lakhs to its shareholder. Therefore, it can claim deduction under ATM. ATM deduction is allowed how much? Dividend received compared with dividend paid, whichever is earlier. And you have to distribute the dividend 1 month prior to the due date of filing of return. Yes, they are distributing 15th of May 2026, which is well before 1 month prior to the due date of filing of return. Therefore, the company can claim the deduction definitely. There is no doubt about it. I hope it is clear to all of you. So, after this, you have to just compute what? Tax, 22% tax, 10% surcharge, 4% cess. That's it. It's a very simple question, nothing great as such. Let's move on to the next question. Question number 2. There is a foreign company, Black and Brown, which is incorporated in country X. And they have an agent, Mr. Lal, in India. Mr. Lal does what? Mr. Lal does stock of goods in India on behalf of the foreign company. He also delivers goods regularly on behalf of the foreign company. The foreign company does not have a permanent establishment or fixed place of business in India, and also there is no DTAA between India and foreign country. So this is the basic information which is given to us. Now we need to find out the tax implication of the following items. First of all, the foreign company is earning income from delivery of goods by Mr. Lal. So do you remember that in section 911 we have seen that if a non-resident has an agent in India and that agent in India regularly deliver goods on behalf of non-resident, then that income is deemed to accrue or arise in India, that amounts to business connection. That is the same thing which is happening over here through Lal Singh. Foreign company is BNB, Lal Singh is agent. Agent is regularly delivering goods in India. Therefore, this 2 crore will be taxable in India on the behalf of foreign company in India, as per 911 business connection. Second point, the foreign company is earning technical services of 55 lakhs net amount after deducting expense of 6 lakh rupees. Now here ICAI has taken 2 views. View number 1, if there is an agreement between the foreign company and the Indian company, and the agreement is approved by central government, then you can take 115A, and if you take 115A, then it will be subject to tax at 61 lakh rupees, because in 115A you do not get deduction of expenses. But if you assume that there is no agreement which is approved by central government, then normal provision will apply, 115A will not apply. In that case, you have to tax at net income. Net income will be taxable, 55 lakhs will be taxable at normal rates. So if you go for 115A, 20% tax, but at gross income, if you go for normal provision, then 55 lakh rupees income at normal rate. This is what this point is all about. And the third one and the last one over here is, there is a long-term capital gains on unlisted debentures of Indian company of 14 lakh rupees. So this will be subject to 12.5% tax because this is sold after 24 months. Therefore, this is long term. This will be subject to 12.5% tax. One last point is given to us here for confusion purpose. BNB has paid a tax of 50 lakh in country X. So what should I do with that? See, BNB is not a resident of India. India will give relief to whom? India will give relief to Indian residents, not to foreign residents. So BNB has paid tax in India, or BNB has paid tax over there. India has nothing to do with that. Whatever tax BNB has paid in India or whatever tax BNB has paid outside India, everything will be considered as a relief in his country only, not in our country. India will not give relief to non-residents. India gives unilateral relief under section 91 to our residents, not to foreign residents. Therefore, this last line you can write a note. This has nothing to do with the question. I hope it is clear to all of you. Now let's move on to the third question. Question number 3, which is on charitable trusts. In part 1, there are 2 parts. That is a charitable trust which has received 5 lakh rupees as a corpus donation. Okay. Now they are saying that the trust is making a contention that because they have received a corpus donation, that is fully exempt. It's not like that. Corpus donation is not by default exempt. It is exempt provided you invest in the mode specified in 11.5. So if you invest the corpus donation in the mode specified in 11.5, only then it is exempt. Otherwise, it is not exempt. Therefore, the contention of the trust is wrong. The second point, which is asked in this first question itself, the trust has taken a loan of 20 lakhs from a bank, and out of that 18 lakh is used for construction of building. Now the trust wants to claim 18 lakh as deduction. Not allowed. If you take a loan and incur an expense, then that expense is not allowed. That expense is allowed on repayment of loan. That too if you repay within 5 years. So if I take a loan and expense, if I take a loan and incur an expense, that expense is not allowed as an application. It will be allowed only if the loan is repaid. That too now an amendment has been made in Finance Act 2023 that the loan has to be repaid within 5 years if you want to claim that repayment of loan as a deduction. I hope it is clear to all of you. Next question. Smile Foundation is not for profit organization. It runs a secondary school. Okay. Now they are receiving some voluntary contribution and government grant total of 30 lakh rupees, 14 and 16 lakhs breakup. Now they are making an argument that is the trust required to get an approval under 1023C? The answer is no. They are not required to get approval. It is exempt. Why, sir? It is exempt because it is a substantially financed institution by government. Sir, how, sir? See, the total grant received, total amount received is 30 lakh. Out of that, how much donation is received? How much grant is received from government? 16 lakh rupees. Out of that, 15 lakh rupees is received from government. 16 lakh rupees is received from government. Therefore, out of 30 lakh, if 16 lakh is received from government, then more than 50% is financed by government. Therefore, it is by default exempt. They need not have to take any registration. They need not have to take any registration. A substantially financed institution means what? A substantially financed institution means an institution where the government grant is more than 50% of the total donations. So here the government grant is more than 50% of total donation. Therefore, this trust is not subject to take any approval. They can claim exemption without approval. And last but not least, a trust is registered under 12AB. It is also registered under 1023C. It wants to enjoy both. Both you cannot enjoy. It is written in section 11 subsection 7 that if you are registered as 12AB trust, then you cannot enjoy 1023C also. You have to surrender one of them. And from 1st October 2024, I have told you already that from 1st October 2024, the government is not accepting new application under 1023C. The doors of 1023C are closed. But still, if you have earlier registered under both, you cannot claim both exemption. You have to surrender one of them. You cannot claim both the exemptions simultaneously at the same time. I hope it is clear to all of you. So this is what this small question is all about. Next question, question number 4, which is on TDS question. Question number 1. In TDS, we need to identify whether TDS is applicable or not. So Mr. Rajat is there. The age of Mr. Rajat is 79 years. He is a resident. He has a saving bank account. He has a fixed deposit account in an ABC bank. Now he is earning following incomes from ABC bank. He is earning interest on saving bank 75,100, pension of 55,000 rupees per month, and 1,20,000 rupees interest on fixed deposit. He does not have any other income. He is following old regime. Now what is the ultimate conclusion of this question? The bank will deduct TDS under 194P, a special section. Do you remember 194P? Count conditions with me. 194P, count conditions with me. Condition number 1, if assessee is an individual, he is a resident, he is 75 years or old, and if he earns pension from a specified bank, and also interest on FD, interest on saving bank from the same bank, pension should be earned from the same bank, interest also should be earned from the same bank. FD interest, saving bank interest, both are covered. Even RD interest is covered, recurring deposit. But the pension and the interest should be earned from the same bank. Then the bank will compute the total income of the assessee. The bank will deduct exact TDS based on slab rates, old regime, new regime, as the case may be, is followed by the customer. Here the customer is following old regime, so the bank will deduct TDS as per old regime. And then the senior citizen who is 75-year-old, he is not liable to file the income tax return. So this is what this question is all about. Here the TDS will be deducted under 194P by the bank. How the bank will compute the income? Let's see. First of all, salary income, pension 55,000 into 12. Gross salary minus 50,000 standard deduction for old regime. Then 75,100 interest on saving, 1,20,000 interest on FD. From that 80 TTV deduction, whatever is the net income on that, bank will exactly compute the tax and will deduct the TDS. After that, the senior citizen do not have to file the income tax return as per 194. I hope it is clear to all of you. Next question, beautiful question. Aryan Limited is a domestic company having last year turnover more than 10 crore rupees. So if the Aryan Limited is a buyer, if the buyer's last year turnover is more than 10 crore rupees, last year business turnover is more than 10 crore rupees, buyer is liable to deduct TDS under 194Q if the purchase of goods exceeds 50 lakh rupees during the financial year. How much TDS? 0.1% on excess amount. Let's see how much they have purchased. They have purchased 85 lakhs. Excluding purchase return from Varun and Company, which is a residence. Yes, the seller should be resident. When should I deduct the TDS? On payment or credit, whichever is earlier. The other person is giving what? The other person is also giving PAN to us. So we will deduct TDS at 0.1% only. Now let's see when we should deduct TDS. First, we are purchasing on 25th of May, 30 lakhs. So no TDS because the amount is not exceeding 50 lakhs. Then on 28th of June, we are purchasing another 25 lakhs. So now 5 lakh is exceeding 50 lakhs. Therefore, on 5 lakhs, 0.1% TDS will be deducted on 28th of June. I hope it is clear to all of you. Third one, on 10th of December, 20 lakh, and again we are purchasing. So again, we will deduct 0.1% TDS on 20 lakh. I hope it is clear to all of you. But out of this 20 lakh, 5 lakh is returned in future. And 5 lakh goods are returned by the buyer and money was also refunded. So remember, CBDT has given a circular that if you have already deducted TDS and paid to the government, and later on if you have returned the goods and money is refunded, you can adjust that much TDS against future purchase. So TDS of 5 lakh rupees, you can adjust against future purchase. So in future, against same seller only, not against different seller. So again, same seller, we are again purchasing 10 lakh rupees in future. So now you have to deduct TDS only on 5 lakh rupees. You can adjust the previous purchase return against this particular purchase. So how much we have returned earlier? 5 lakh rupees goods you have returned earlier, taken the money refunded also. So now that 5 lakh rupees you can adjust here. So now on 20th of February 2026, TDS will be deducted only on 5 lakh. 5 lakh will be adjusted. Therefore, 5 lakh into 0.1%. I hope it is clear to all of you. Sir, what if the money would have not been refunded, but the goods would have been replaced? Then no effect in future. If the money is refunded, if you have returned the goods and the money is refunded, then adjust in future against same seller. If the money is not refunded, but the goods are replaced by the seller, then no effect in future. Then don't give any effect. Then in future also deduct TDS on 0.1% on 10 lakh rupees only. I hope it is clear to all of you. So this is what this question is all about. Now question number 5 talks about whether it is a tax planning or tax management or tax evasion. Let's see. An individual is investing some money of 10,000 rupees in Sukanya Samriddhi scheme. Yes, Sukanya Samriddhi scheme is nothing but it is allowed under 80C by the government of India. Therefore, it is tax planning. Another is companies obtaining Form 60 from the customer from all those customers who is not providing PAN. So if the customer is not providing PAN, you have to take a declaration in Form 60. So this is nothing but tax management. Third one, a partnership firm is purchasing a refrigerator and installing that refrigerator at partner's home. You are purchasing a refrigerator and you are installing at partner's home and you are claiming depreciation on that. It is a tax evasion. Clear case of tax evasion. Clear case of tax evasion. And the fourth and the last point, a company pays 4 lakh to Mrs. D, wife of director, who although being a qualified professional but is a housewife. You are giving money to wife of director, who is a housewife. The purpose is to increase the total income. It's a clear case of tax evasion. You are unnecessarily giving money to the wife of director so that the expense of the firm, expense of the company increases and the company can claim tax benefit. And wife is anyways not doing anything, therefore her income will be exempt up to 5 lakh rupees as a rebate. Therefore, it is a clear case of tax evasion. I hope it is clear to all of you. And one last question is a theory question. You can see this later on. It's a very, very straightforward theory question. You can watch it later on. Okay, I'm not going to talk about theory question. So this is what this paper was all about. It was a very simple and small paper. The big papers will come now. I'll take a break for 1 minute. Then I will continue. Let's move on to the next paper, that is November 2022 paper. The very first question over here is again on total income. We are supposed to compute total income as per the normal provision, not as per 115BAA. Okay, as per the normal provision, you have to compute the total income. Now be very careful. There are some very important points which are given in the first line, that is the assessee is a pharma company. First of all, assessee is a resident. But the most important line is that it is a company in which public are not substantially interested. What do I mean by this line? It means it is a closely held company. Which company? It's a closely held company. What do you mean by this? It means there are two important sections which can be made applicable for this assessee. One is section 68, that is unexplained cash credit, and one is section 79, set off and carry forward of losses in case of closely held company. Either of the two provisions may be applicable. I am not saying it is 100% applicable. It may be applicable. That is the reason they have used such words, that is public are not substantially interested. Okay, we will check which points are applicable, which section is applicable, especially for closely held company, which is covered in this question. The profit of the assessee is 50,75,000 rupees. You are purchasing some one-time license of 12 lakh rupees, which is a franchise fee on 28th of July. Very routine adjustment. Add back this and then reduce 25% later on. But here the ICI has made a very strange assumption which they have not made earlier. Okay, what strange assumption they have made? You know, they have said that add back 12 lakhs. Add back 12 lakhs, but don't reduce separately later on. Generally, we reduce not separately. In most of the adjustments, we have done like that only. But here ICI is saying don't reduce separately. Why? They are saying that this income tax depreciation which is given below now of 14,50,000 would have included this 25% depreciation also. Now, what kind of strange assumption suddenly they make? Now, the board of studies member change now over the period of time. So, they make their own assumptions. So, what should we do, sir? You can do either of the things. You can reduce or you can write a note that it is already included. You can reduce separately also, or you can write a note also that it is already included in the depreciation amount. Therefore, we are not reducing. Okay, you just inform the ICI that I know the adjustment. Okay. Now, second, you are incurring some expenses on what? On issue of convertible debentures. So, if you incur some expense on issuing convertible debentures, it's not a capital expenditure. It is allowed as an exemption. It is allowed as deduction. Therefore, you can claim, because issuing convertible debentures does not lead to permanent capital in the business. Therefore, because it does not lead to permanent capital in the business, you can claim that as a deduction. Okay. Now, next one is a very intelligent adjustment. With you are making two payments. Very intelligent and very dangerous adjustment it is. You are making two payments. 2,25,000 you are making to share broker as a commission, and 1,20,000 you are paying to commodity broker for buying some commodity as a commission. In both the transaction, you have not deducted TDS. To share broker also you have not deducted TDS, and to commodity broker also you have not deducted TDS under 194H. Commission TDS is covered under 194H. Now, what is the treatment of this adjustment? Now, ICI has taken two views. View number one, if you assume that the assessee is not a trader, or assessee is not a trader of share and commodity. So, if it is view number one, if he is not a trader of share and commodity, then both the expenditure will be disallowed. Because if you are not a trader of share and if you are not a trader of commodity, then these are not business expenditures for you. Therefore, it will not be allowed as a deduction. Both of them will be disallowed. But the second assumption, if you are a trader of commodity and if you are a trader of share, then you can claim that as a deduction. In that case, you need to ask whether TDS is deducted or not. So, if you are a trader, then on share broking, whether am I liable to deduct TDS? Not liable to deduct TDS under 194H. There is a clear exemption that when you pay commission or brokerage on securities, no TDS is applicable. So, if no TDS is applicable, then this expenditure cannot be disallowed. Because TDS is not applicable only, then why should I deduct TDS? Second point, that if you are paying 1,20,000 as a brokerage on commodity, then TDS is applicable under 194H. Go and check. And in that case, if you have not deducted the TDS, then 30% of 1,20,000 will be disallowed. So, again, I am saying both the views. View number one, let's assume that it is we are not trader. So, if you are not trader, both expenditure disallowed. Let's assume we are trader of both. If you are trader of both on commodity commission, you have to deduct TDS. If you have not deducted, 30% disallowed. And on share broking, no need to deduct TDS. If you have not deducted TDS, still fully allowed. I hope it is clear to all of you. Beautiful question it is. Next adjustment. You are contributing 15% of basic salary to employees pension scheme. How much is allowed as a deduction? It is allowed only 14% of basic plus DA in terms. But you are contributing how much? You are contributing 15% of basic salary. Now, let's see how much you are contributing. 6 lakhs is the basic salary. You are contributing 15% of that. 15% of 6 lakhs comes to 90,000 rupees. So, the actual salary is 19,000. How much is allowed? How much is allowed is basic plus DA in terms is allowed. Now basic is 6 lakhs. What is DA in terms? Total DA is 30%. Therefore 30% of 6 lakhs comes to 1,80,000. Of that 50% is DA in terms. So out of 1,80,000, 50% is 90,000. 90,000 is DA in terms. Therefore basic is 6 lakhs. And DA in terms is 90,000. Therefore, 6,90,000 is basic plus DA in terms. Therefore, 14% of that is allowed as reduction. 14% of that is 96,600 is allowed, but you are only giving how much? 90,000. Therefore, fully allowed. You are not paying more than 14%. 14% is 96,600. You are actually paying only 90,000. Therefore, full 90,000 will be allowed. Nothing to disallow. Write a note and leave it. I hope it is clear to all of you. Next one, you are giving 7 lakh rupees as a freebie to medical practitioner. Disallowed. Pharma company, you are a pharma company. That's the reason it is very important line over here at the beginning of the question. A pharma company giving freebie to whom? Giving freebie to medical practitioners is disallowed. It is not allowed as per explanation 1 to section 37(1). Next, you are incurring some 5,20,000 rupees on feasibility study on examining proposals for technological advancement of existing business. Existing business we are doing, then it is allowed. Even though there is no asset which is created. If asset would have been created, we would have capitalized to the asset, but asset is not created and the expenditure is done for technological advancement of existing business. Therefore, it should be allowed as a reduction. Next, depreciation as per books of accounts will be added back. Next, again a routine adjustment. Employees contribution will be disallowed because employees contribution has to be paid by 15th of the following month. Employer contribution will be allowed because employer contribution can be paid up to the due date of filing of return. Okay. So therefore, this will be disallowed. Employee contribution disallowed. Employer contribution will be allowed to you. Next is Swachh Bharat Abhiyan, 2 lakh rupees you are paying. So add back here Swachh Bharat Abhiyan. Add to PGBP, claim under chapter 6A, assume that the payment is made other than cash, because if you make by cash, then the deduction under 80G is no 80GGB is not allowed. Okay. Next, you are receiving some industrial power tariff concession from the central government. So if you receive any industrial power tariff concession, etc. from government, it is an income under section 2, clause 24, subclause 18. Therefore, let it be part of income and write a note on that. Next, in the opening and the closing stock, you are including some interest expense, which is not allowed. So in the opening stock, you are including 6,85,000 rupees as an interest expense, which is not allowed. Add back 6,85,000. And in the closing stock also, you are including 5,65,000 on the credit side of P&L. So reduce 5,65,000. So opening stock wrong inclusion will be added back. Closing stock wrong inclusion will be reduced. Next one is a profit from setting up of what? Next one is a profit from setting of warehouse warehouse for storage of sugar. How much profit you are earning? Now this is a 3580 business. You have to reduce this profit from here. Show separately. Show separately. Don't merge with this pharma business. Reduce this 10 lakh from here. Show separately. And how much expenditure you are incurring for the 3580 business? You can check it in the fourth adjustment. 35 lakhs you have incurred. Out of that, 20 lakh is land. Therefore, only 15 lakh will be allowed. So reduce this 10 lakh from here. Show separately as a 3580 business. So 10 lakh will be the profit. From that, 15 lakh will be the expense. 5 lakh will be the loss of 3580 that you have to carry forward. That loss you cannot set off against what? Against pharma business. That is not allowed. 3580 loss can set off only against 3580 income for infinite number of years as per section 73A. I hope it is clear to all of you. Next one. You have collected 14 lakh GST from customer and then remitted to government. So 14 lakh collected, 14 lakh remitted, deduction fully allowed. Nullified. Receive 14 lakh, paid 14 lakhs to government, fully allowed. Then you file an appeal to the court. The court has told the GST department to grant you refund of 5 lakhs. So now refund of 5 lakh has been received. Out of that, 3 lakh you have returned to the customer. Now whatever refund you are receiving, that is ultimately a customer's money only. Because GST is not your money, GST is customer's money. You have taken from customer and given to government. Now government has refunded it. So you should give it back to the customer. So you have got 5 lakh as refund, but you have given only 3 lakh to customer. Therefore, 2 lakh will be added to your income. That will be your deemed income. 41 subsection 1. Recovery of an expense. You have claimed deduction of that GST earlier. Now you are recovering. Now that 2 lakh will be income. Whenever you will give that back to the customer, at that time that 2 lakh will be claimed as a deduction once again. I hope it is clear to all of you. Next one. This is a very important adjustment. Because of this adjustment, only the institute has given this line at the beginning of the question. The public are not substantially interested. See, it's very simple that if you are a closely held company, then your 51% of the shareholders should be same if you want to carry forward the loss. Now here 51% of the shareholders are changing. Why? There was one person, Mr. X, who was holding 55% shares. Now he sold his entire share in the current year. Now 55% shareholder change. Therefore, this loss of 13 lakh rupees of 23-24 cannot be carried forward and set off in the current year. Because 51% shareholders have to be changed and 51% of the shareholders have changed. They have to be same if you want to carry forward and set off. But because they have changed, you cannot carry forward and set off. You can write a note on section 79 over here. And the last adjustment is income tax rules. Depreciation is 14,50,000 rupees. You can claim this as a deduction. I hope it is clear to all of you. We are supposed to just compute total income, and we have computed the total income. That's it. Nothing great is asked in this question. Question number 2 is again a very intelligent question. In this question, we are supposed to compute total income, tax payable, AMT also, alternate minimum tax also, AMT credit also. All these things we are supposed to compute. It's a question on LLP. This LLP has a SEZ since 2019. Now, because it has an SEZ unit since 2019, it is eligible for deduction under 10AA, but only 50% because the unit is more than 5 years older. 50% deduction will be available of the profits. Now, because it is a partnership firm question, LLP question, you have to first compute book profit. Then you will compute remuneration as per 40B. Then you will compute total income. Then you will compute tax as per normal provision. Then we will compute AMT, and then we will compute AMT credit. It's a long question. So first we will compute book profit. Okay. So what is book profit? Book profit is nothing but PGBP income only. Just add remuneration debited to PNL already. So let's compute book profit. The net profit of the PNL as per the LLP 65 lakhs. Profit on sale of license. Is it a part of book profit? Yes. Book profit is nothing but PGBP income. Profit on sale of license is a part of book profit. Don't do anything. Remuneration to partner, add back. This is actual remuneration. Interest 16% not allowed, only for 12% allowed, add back 4%. Donation to political party, add back now, claim as a deduction later on under chapter 6A. Depreciation as per books of accounts, add back. Then remuneration to partners and interest are authorized. It's very important. If you want to claim deduction of remuneration and interest, it should be authorized by deed. Business loss you cannot reduce while computing book profit because business loss are not covered in section 28 to 44. It is covered in section 72. Yes, unabsorbed depreciation you have to reduce while computing book profit. And then you have to compute the depreciation as per the normal provisions. That is, whatever is your income tax depreciation, that you have to reduce. I hope it is clear to all of you. After doing all these things, you will get what? You will get this. Your book profit. Your book profit is how much? 87 lakhs. Now, on this 87 lakhs, you will compute what? You will compute your remuneration. How will you compute remuneration? Up to 6 lakhs, 90% of book profit, and above 6 lakhs, 60% of book profit. It comes to 48 lakhs 60,000 rupees plus 5 lakh 40,000, total 54 lakhs. What is your actual remuneration? The actual remuneration is as follows. You can check it over here. The actual remuneration is 58 lakhs. And the maximum remuneration is how much? The maximum remuneration is how much? The maximum remuneration is 54 lakhs. Therefore, the allowed amount will be how much? It will be 54 lakh compared with 58 lakh. Whichever is lower will be allowed as deduction. I hope it is clear to all of you. Is it clear? I hope it is clear. Now the real question comes. Now we have to compute the 10AA deduction. But after this, you will do one thing. You will first reduce the losses. First, you will reduce the losses of 4 lakh rupees is the loss which you have to reduce now from your PGBP income. And now your ultimately gross total income comes to 29 lakh rupees. Now from this 29 lakh rupees, you will compute 10AA deduction, and at the end you will take what? 80 GGB deduction of political party donation which you have given. Now how much 10AA deduction we will compute? For 10AA deduction, we need three things. One is export profit, one is export turnover, one is profit, and one is total turnover. Let's try to understand all three of them one by one. Pay attention please, all of you. What is export turnover? But before that, just a second. Let me check. There is some issue over here. So now we have to compute export profit, export turnover, total turnover, and profit from the SEZ undertaking. Now let's see one by one. First, I will find out export turnover. The total turnover of the SSC is 45 crores, but out of that, only that much turnover will come in export turnover, which is received within 6 months from the end of the financial year. Therefore, I have to take only 38 crore in export turnover. From that also, if there are any charges like insurance, freight, telecommunication charges, I have to reduce that. So therefore, the export turnover eventually will come to 36 crore. Now I have to consider the total turnover. What is the total turnover? The total turnover is 45 crore. And in the total turnover, you don't have to check how much money is received in India, how much money is not received in India. You have to take everything. While computing export turnover, you have to check how much money is received in India within 6 months. But while computing total turnover, you don't have to check how much money is received in India within 6 months. You have to take everything. But only one thing has to be reduced, that extra charges like insurance, freight, telecommunication charges, those have to be removed. Therefore, that is 5 crore in 45 crore. Therefore, total turnover comes to how much? 45 minus 5, that is 40 crore. Therefore, I have got two things. Export turnover 36 crore, total turnover 40 crore. Now I have to find out profit, which I have to multiply. And then I will take 50% of that, because this is the 6th year of business. What is profit? Profit is given here. The profit of the SSC is around, we have already computed the profit. We have computed the profit 33 lakhs. Now the question is whether we should take 33 lakhs or 29 lakhs. ICAI has taken two views. First view, ICAI has taken that you should take 33 lakhs, which is before loss. Second view, ICAI has taken you should take 29 lakhs, which is after loss. Both the answers are correct. But from both the answers, you have to reduce one thing, profit on sale of license. Because profit on sale of license, duty drawback and export incentives are not part of what? Are not part of what? Profit of the SEZ. Therefore, if you are taking 33 lakhs, remove profit on sale of license. How much is the profit on sale of license over here? 9 lakhs. Therefore, in that case, your profit will be 24 lakhs. If you are taking 29 lakhs, then remove 9 lakhs, then in that case, your profit will be 20 lakhs. See, they have taken both. In one case, in the original solution, they have taken 24 lakhs, that is 33 minus 9. But they have also given a note below and they have said that you can also take 24 lakhs. Therefore, that will be 29 minus 9, that will come to 20 lakh rupees. I hope it is clear to all of you. You can solve by either of the way. After doing this, you have to compute your deduction under what? SEZ of 10AA. How much deduction you will claim? Multiplied by export turnover divided by total turnover into profit into 50%. So that your deduction will come to how much? 10,80,000 rupees. Then you will claim one last deduction, 80 GGB, that is political party donation. Then you will apply your 30% tax, 4% cess, that will give your tax liability. I hope it is clear to all of you. Now the answer is not ended. After that, you have to compute your adjusted total income. Adjusted total income is nothing but, because you have to compute AMT also, it is total income plus 10AA deduction. That is 15,20,000 plus 10AA deduction. This is your adjusted total income. On that 18.5% tax, 4% cess, that will give you ultimately your AMT liability. And then compare your AMT with your normal, whichever is higher. If AMT is higher, you will get your AMT credit. In this question, AMT is higher. Therefore, you can take AMT credit in this case of 26,000 rupees. I hope it is clear to all of you. Let's move on to question number 3 now. Question number 3 is on trust. Taxation of trust. There is a trust by the name called as Fit Me Foundation. Now they have received 125 lakhs as a corpus donation and they have invested that corpus donation in private sector company. Not allowed. See, I have told you earlier also, corpus donation, if you receive it, is exempt provided you invest in the mode specified in 11.5. And if you see the 11.5 modes, private sector company shares are not covered in 11.5. If you invest in private sector company shares, it is not 11.5 mode. Therefore, you will not get the exemption. Sorry. Your exemption will be denied in this case. I hope it is clear to all of you. Second, apart from above, they have also received 95 lakhs other donation, which is voluntary donation, not corpus donation. Yes, they can claim exemption for that. And 60 lakh for fees for providing yoga services. Yes, yoga is also covered in charitable purpose. So for other contributions, for voluntary contribution and fees from yoga services, yes, for that they can claim 15% exemption, and on balance amount, they have to apply it for the purpose of claiming exemption. If they want exemption, they have to apply for the purpose of the trust. If they apply for the purpose of the trust, on the balance amount, they can claim exemption. I hope it is clear to all of you. Next one is a similar question which we have done earlier. Nagaraj is a founder of SSVB Trust. Okay. This trust is a hospital. Okay. So Nagaraj is a founder of the trust and the trust is a hospital. Now, Nagaraj's son is admitted in the hospital. Is there any wrong if Nagaraj's son, that is the trustees or founder's son, is admitted to the hospital? No, there is nothing wrong. First of all, trustee's son or founder's son is a specified person under section 13 subsection 3. There's nothing wrong in admitting a trustee or founder's son in the hospital. There's nothing wrong. You can do it. But the question over here is, you cannot pass unreasonable benefit to them. To others, you are charging 5 lakhs. To Nagaraj son, you are charging 3 lakh rupees. That is wrong. Here, the provisions of lot of provisions of income tax law will apply. Like this extra 2 lakh rupees which you are providing, unreasonable benefit. On that, 115 BBI will apply. 30% flat tax. Then 271 AAE penalty will be imposed if you do for the first time 100% of unreasonable benefit passed on to the specified person. Second time, subsequent time, 200% of the unreasonable benefit passed on. And this 2 lakh rupees which you are incurring now, extra 2 lakh rupees, that will not be subject to what exemption also. So there are a lot of complications. We have seen a similar, but whether the registration will be cancelled? No, registration will not be cancelled. In such case, you have to bear 115 BBI. In such case, you have to bear 271 AAE. You will not claim, you will not get exemption under 11 and 12, but the registration will not be cancelled in this case. Don't worry about it. I hope it is clear to all of you. Okay. So this is what this question is all about. Now let's move on to the next question. Very, very beautiful question. Next question is also a beautiful question of DTAA. Mr. Ritesh is a resident individual aged 42 years. We have to compute total income and tax payable of Mr. Ritesh and follow old regime. You have to follow old regime for the purpose of calculation of tax. Now, the very first thing which we need to understand over here is, we will compute the total income of Ritesh in India. First, income from business in India, 4,85,000, that I will write here. Income from royalty from country N. Now, for that, we need to read one additional information here, because India and country N has a DTAA. As per DTAA between India and country N, the royalty will only be taxable in the source state. Which is the source state? Source state is country N. Because Ritesh is a resident of India, therefore India is a resident state and country N is a source state, and the royalty earned from country N is taxable in country N only. Therefore, you do not take this in India, please. Do not take this in India. This is not taxable in India. Ignore this. I hope it is clear to all of you. What about interest from country Y? What about interest from country Y? For that, we need to read, as per DTAA between India and country Y, interest can be taxed in both the states. So, interest can be taxed in India also, interest can be taxed there also. So, interest you will take in India, and then in India we will give him a relief. DTAA relief we will give. Okay. Because it is written, the tax credit will be available in respect of tax payable in the resident state. So, you will get the relief in India. So, country Y you will get relief. Country Y interest you have to include. Now, the question is, this is which interest? Because it is given in dollars, you have to convert in rupees as per Rule 115. And in Rule 115, for interest, there are two rates. For interest other than security, it is last day of the TTBR, last day of the financial year TTBR. But for interest on security, it is the TTBR of the preceding month in which it is earned. So, which interest it is? I don't know the nature of interest. It is not clearly written in the question that which interest it is. Is it written anywhere? Can you see whether it is interest on security or other than security? I am assuming other than interest on security so that I can take 31st March TTBR. You can assume interest on security also, but I am not assuming. Even ICI is not assuming. ICI is also assuming interest other than security. So, let's see the TTBR of 31st March. It is 80 rupees. So, you will multiply 9,500 into 80 rupees. That will be the income which is taxable in India. And the third income, agriculture income in country M. So, in country M, it is exempt, check please. But in India, foreign agriculture incomes are not exempt. So, you will take this in the income. Okay. So, ultimately, how much points, how much income will come in the total income? 3 income will come. Let's see, the total income will include which all things? One is business income from India. Then country N royalty will be taxable only in country N. So, you will not take in India. Then country Y interest other than security, you will multiply by 80 rupees, 80 into 9,500. We are assuming to be other than interest on security. And then agricultural income, which is taxable in India, not taxable in country M. After that, you will compute tax on 13,54,000 and you will find out what average rate in India. The tax is 227,448 divided by 1354. The average rate in India is 16.798. Now we need to find out how much is doubly taxed income. Is this business income doubly taxed? No, it is only taxed in India. Is this royalty doubly taxed? No, royalty is taxed in foreign country. It is not doubly taxed. Is this 7,60,000 doubly taxed? Yes, it is taxed here also. It is taxed there also. Is this 1,09,000 doubly taxed? No. Country M agriculture income is exempt. Agriculture income is only taxable in India. Therefore, it is not doubly taxed. Therefore, only doubly taxed amount is 7,60,000. Therefore, on 7,16,000, you will apply India's average rate. India's average rate is 16.798. This is the tax payable in India on 7,60,000. Now, how much is the tax payable in foreign country on this particular income? Let's see. You have paid $950 in country Y. When you have paid on 21st of February. So you will now convert this tax into rupees as per rule 128 now. So always remember, to convert tax, rule 128 is there. To convert income, rule 115 is there. Now we are converting tax. So you will apply rule 128 on $950 which you have paid in country Y. $950 at what rate? The rule 128 says that last month TTBR. The tax is paid in February. Last month is January. January TTBR is 78. So you will multiply 950 into 78. That is the tax paid in foreign country. 950 into 78, 31st January TTBR 74,100. Whichever is lower will be allowed as relief from your total tax. So 74,100 will be allowed as a relief. I hope it is clear to all of you. Beautiful question it is. You can check it once. Now next question. Next question is on TDS. Okay, you would have understood the pattern in which ICI is asking total income, then some questions on what trust, then some questions on TDS, etc. This is the pattern in which ICI asked the question in most of the attempts, including Jan 26 attempt. The pattern was same only. Now, TDS and TCS we need to answer. The very first question over here is, there is an Indian company, TAM Electronic Limited, which is importing certain computer software from a Japanese company, from a US company, Jam Electronics. So Indian company is importing some what? Computer software. But for what? For reselling it to end users in India. Now remember, there is a Supreme Court judgment on this, engineering analysis excellence, long name is there. That if you purchase computer software, for what purpose? For reselling it to for reselling or for end use. If you are purchasing computer software for reselling or for end use, then the DTAA says that as per the Supreme Court judgment, as per DTAA, such amounts does not amount to royalty. It does not amount to royalty, and if it does not amount to royalty, you do not have to deduct TDS. You do not have to deduct TDS. Do you remember that? It was covered in the chapter of non-resident taxation. We have done that. That if you import computer software for end use or for reselling, it does not amount to royalty. Therefore, no need to deduct TDS. Next question. There is a public sector bank which paid 20 crore to a company that provides ATM network to the bank as commission for facilitating ATM, debit card, credit card. So I am a bank, there is a company which is providing me some services, I have paid 20 crore to them, they are providing some ATM, debit card, credit card services to me. So I have paid 20 crore as a commission. Should I deduct TDS? No. 194H is not applicable in this case. This is a case law of UCO Bank, I think so, UCO Bank case law. 194H is not applicable. The reason is, I don't know the exact name of the case law, but this is the case law which is covered in our book also. 194H is not applicable because in the case law it was written there is a relationship of principal between bank and that agency. So if there is a principal relationship, 194H is not applicable. 194J is also not applicable because there is no human intervention or no manual intervention. It is totally machine intervention. So if it is a total machine intervention, then 194J is not applicable. To apply 194J, there has to be some professional services. There has to be some manual intervention. Therefore, neither 194H nor 194J will be applicable in this case. Question number 3 and 4 are very simple question. Question number 3 we have done so many times in class also, that I have come to you. You are a contractor. I have come to you and I have told you that you have to stitch shirts for me. You are saying cloth. I said that cloth purchased from me or from my associate entity. So if you purchase cloth from me or from my associate enterprise, and if you stitch shirts for me, then whenever I will make you a payment, I will deduct TDS. Now how much amount I will deduct TDS? If you provide me breakup, then I will deduct TDS on stitching charges on service portion. If you don't provide me breakup, then I will deduct TDS on the entire amount. On the entire amount, I will deduct TDS in that case. So in this case, that is only happening. I am telling the contractor to stitch shirts. The contractor is asking for the material. I am selling, take material from my related party under 48(2). So in that case, I have to deduct TDS, and also the contractor is providing a consolidated invoice, so I have to deduct TDS on the full amount, not on the service portion. I hope it is clear to all of you. Next one, there is a Canadian citizen, foreign citizen, which is a non-resident, which is a sportsman. So 194E will be applicable. So if you are a foreign citizen and if you are a non-resident, then the provisions of 194E are applicable. If you participate in matches in India, 20.8% TDS will be applicable, 20 plus 4%, 20.8. And if you earn some honorarium from writing an article in sports magazine, and even advertisement income will be also subject to 20.8% tax. I hope it is clear to all of you under 194E. But this is only applicable to non-resident sportsmen who are not citizen of India. You should not be citizen of India. Okay. Next question is a transfer pricing question on cost plus method. The ICI is very clearly writing which method to follow. Cost plus you have to follow. In cost plus method, what happens when I'm providing some services or when I'm selling some goods to my associate enterprise? First, I have to find out the cost with respect to my associate enterprise. Then step number 2, I have to find out the third party margin, arm's length margin. Then I will adjust the margin and I will apply on my cost. I will get my arm's length price. So here MNO Limited is an Indian company and MNO INC is a foreign subsidiary. Therefore, MNO and MNO INC are deemed to be associate enterprise. The transaction between them will be deemed to be international transaction. And HTY Hong Kong is a third party. It's an uncontrolled transaction. It's an uncontrolled transaction. First, we will see some basic information. You are billing MNO $85,000 per month. All data is per month. So we will make calculation on per month basis only. You are billing HTY third party $92,000. The direct cost is $120 per hour and indirect cost is $210 per hour. Now, MNO works 9 hours for 18 days and STY works, for STY we work 18 days, 8 hours. So, both are 18 days only, but for MNO, INC we are working 9 hours and for STY we are working 8 hours. Apart from that, some other informations are also given. Now, we need to find out two things here. What is the margin of HTY? HTY margin, because HTY margin is third party margin, that we will apply on what? That we will apply on MNO cost. And that will give us our arm's length price. Let's try to find out the HTY margin now. What is the margin of HTY over here? First of all, the direct cost of HTY is 120 into 8 hours every day, 18 days. And indirect cost is $210 into 8 hours, 18 days. This is the direct cost of HTY. Okay. 47,520. Is this the only cost which when we provide services to HTY? This is the only cost? No. There is one more cost which we have to incur when we provide services to HTY. That is, when we provide services to HTY, we have to give 1.5% of the direct cost as a warranty cost. That is also a part of cost. So 1.5% of the direct cost, 1.5% of the direct cost is 17,280. That is the total direct cost. Of that 1.5%, that also have to add back. So 47,520 is my direct and indirect cost, and 259 is my warranty cost. This is my total cost of my third party, and my billing amount for third party is $92,000, as you can see over here. Therefore, the differential amount will be my profit. This is my profit. This is my cost. Therefore, my margin is 92.55%. So this is my arm's length margin. Now I have to apply this arm's length margin on my cost. What is my cost when I provide services to whom? MNO INC. So when I provide services to MNO INC, same $120, $210, but I provide services for 9 hours and 9 hours. Days are same, only 18. And in case this is the direct and indirect cost. But when we provide services to MNO INC, we also have to take a loan. Check over here. MNO INC has given a loan to us of 1,20,000 to MNO Limited to purchase hardware at 4% per annum. But we are calculating the data for per month, therefore you have to divide by 12. So we have to also add the interest cost over it. $120,000 into 4% into 1 by 12, $400 we have to add additional cost. This is our total cost. Now on this total cost, you will apply the margin which we have computed over here, arm's length margin. After that, you will get your arm's length price and then find out the differential amount. I hope it is clear to all of you. It's a very good question of DTAA, of transfer pricing, which can repeat in the examination. Be careful. Okay. Next question, very simple question, nothing great as such. Question number 5. The first question, question number 5A, is a case law question of Pepsi Foods Limited. I will give you the background, what has happened in this case. I have told you this many times. We have done a lot of question in the class also. Very important case law it is, very important. Already a lot of time ICI has asked. Now, do you remember that within how much time ITAT has to pass an order under 254? ITAT generally has to pass an order within 4 years from the end of the financial year in which the appeal is filed. But the law says that if an assessee has asked for a stay from ITAT, then ITAT has to grant a stay, but for maximum 180 days, and in that case, the order should also be passed in 180 days. Then the question is that, can the stay be extended beyond 180 days? Yet it can be extended beyond 180 days if the delay in the appeal is not attributable to the assessee. The delay is attributable to ITAT. It is not because of assessee. Then you have to extend up to 365 days. Then the question is, can you extend beyond 365 days? The law says that you cannot. But here comes the Supreme Court in the case of Pepsi Foods Limited, which says that if the delay is attributable to ITAT, not to assessee, if the delay is not attributable to assessee but to ITAT, then beyond 365 days also you have to extend the stay. You have to extend the stay beyond 365 days also if the delay is not attributable to the assessee. I hope it is clear to all of you. This is what it was written in this particular case law. Next one is a question on board for advance ruling. There is an assessee by the name called as Ricky, who is a resident. He is agreed by the order of board for advance ruling. Now the question is that if a board for advance ruling pass an order, is it binding? No, no, no. It is not binding. You can file an appeal to High Court within 60 days. And if there is a reasonable cause, the High Court can also give you extension for another 30 days. Therefore, total 90 days time is there. I hope it is clear to all of you. 60 plus 30. Then there is an Indian public sector company. It wants to go to board for advance ruling, but it has a concern that their case is already pending in front of ITAT. Can they go for a board for advance ruling? See, generally, you cannot go for board for advance ruling if your case is pending in front of income tax authority, ITAT or any court. But for public sector company, there is a relaxation that in case of public sector company, if the case is pending in front of ITAT or if the case is pending in front of income tax authority, still they can go for ITAT. Still they can go for board for advance ruling. For other assessee, this relaxation is not available. This relaxation is only available for public sector undertaking. Yes, for public sector undertaking also, if the case is pending in front of High Court or Supreme Court, they also cannot go. Public sector company can go to BFAR only if the case is pending in front of income tax authority or ITAT. So that by that logic, they can definitely go for this particular thing. Okay. And one last question over here is question number 6. We need to identify whether GAR is applicable or not. In the very first question over here is, there is an Indian company which is making losses, which is doing amalgamation with another company. So that the losses can be transferred to the another company. Whether GAR will apply, GAR will not apply. See, GAR applies when? If there is a tax evasion case, GAR does not apply. If there is a tax planning case, GAR does not apply. If there is a specific anti-avoidance rule, then also GAR does not apply. If there is a no specific anti-avoidance rule and there is a tax avoidance, then GAR applies. Okay. Now it is a tax planning. There is nothing wrong. One entity is into losses, another is into profit. The losses entity is getting merged with profit entity. It is amalgamation. It is allowed as per income tax law. There is nothing wrong in that. Okay. The second question, GAR is applicable. There is one company, A Limited in India. There is another company, C Limited in India. Instead of directly giving the loan to C Limited, what A Limited is doing, it is making one entity in a tax haven, low tax jurisdiction. They are making one entity, B Limited. They are forming one entity in tax haven and they are purchasing the equity of that entity and telling that entity to give loan to C Limited. So rather than giving loan directly to C Limited, A is first giving money to B and ultimately B is giving money to C. Therefore, GAR will apply in this case because it is round tripping of finance, you can say, or you can say B Limited does not have any commercial substance, because in the question is also it is written there is no other activity in B Limited. B Limited is not formed for any other purpose. It is only formed for doing this transaction. Therefore, you can use two important sentences. One, this is round tripping of finance, GAR will apply. Second, B Limited does not have any commercial substance. It lacks commercial substance. Therefore, GAR will apply in this case. And last but not least, there is an entity which is making one unit in SEZ. There is nothing wrong in making unit in SEZ. You can claim deductions by making unit in SEZ. It is clearly a tax planning case. Therefore, GAR will not apply in this case. Okay. I hope it is clear to all of you. And one last question is on declaration of a person as an agent under section 163. We need to say whether the following person can be declared as an agent under section 163 or not. The AO of Mr. Albert, a non-resident, wants to treat the following person as his agent. Now, first, Mr. Albert has a house in Goa. Now, during the year, he is selling this house to Mr. D'Souza to another non-resident. Now, AO wants to treat Mr. D'Souza, that is the buyer, as an agent. Can he declare the buyer as an agent? The answer is yes. Why, sir? Because it is written in section 163 that if a non-resident sell house to another non-resident in India, or if a non-resident sells house or any capital asset to another resident in India, then the buyer can be treated as a resident. Then the buyer can be treated as an agent. Here, who is selling the house? The house is sold by Albert. Albert is a non-resident. It is sold to whom? It is sold to D'Souza. D'Souza is also non-resident. Where it is sold? It is transferred in India. If a capital asset is transferred in India by NR to another NR, then the buyer can be treated as an agent, and he will be responsible for filing the return, for declaration of for filing of return, for replying to the notices, for making payment of taxes, for all the proceedings under the income tax law. The buyer, that is the agent, will be responsible. Second case, Mr. Albert employed Mr. Rakesh. Can an employee also be an agent? Yes, employee can be an agent. The very first point in the definition of agent is employee only, provided the employee should be employee in the current year. Albert was employee, Rakesh was employee of Albert in the last year, not in the current year. He left the company, check. He left Albert in the current year. Therefore, now Mr. Rakesh cannot be held as what? Held as an agent. Yes, if he would have continued an employee in the current year, he could have been held as what? Agent. Otherwise, he cannot be held as agent. To call any person as an agent, you should do the activity in the current year, not in the past year. Okay. I hope it is clear to all of you. So this is what this paper is all about. I'll take a break of 2 minutes. Are you all enjoying? Please say. So let's go ahead with the next paper, that is paper number 3, May 2023 paper. Beautiful paper. It is one of the best paper. Very first question, you are supposed to compute total income and not as per 115 BAA, not as per 115 BAB. Let's start. Assessee is a manufacturer. Assessee has a net profit of 1 crore 25 lakhs. The very first expenditure done by the assessee is an advertisement of 1.6 lakh in cash First of all, mistake number one. Mistake number two, it is done to a sister concern. Mistake number two. So you are violating 48(2) also, 48(3) also. You are making excess payment to related party. You are also making payment in cash. So I've told you in class, if both the mistakes are done at the same time, you have to follow the order of the section. First apply 48(2), then balance amount. If it is more than 10,000, then it is applied, then apply 48(3). So first disallow the excess amount. The 1.6 lakh is the total amount. The market value is 52,000. Therefore, disallow the excess amount. 1,08,000 disallow first, and then balance 52,000 you can disallow under 48(3). So ultimate treatment 1,08,000 will be disallowed under 48(2) and 52,000 will be disallowed under 48(3). I hope it is clear to all of you. Now, next adjustment, you are doing some repair to plant and machinery of 1.8 lakh towards replacement of some worn out part and machinery, worn out parts of the machinery. So replacement of worn out part of the machinery is considered to be a revenue repair. It is considered to be a current repair. You can claim that as a deduction under section 31. It's not a very substantial repair where the capacity of the machine is increasing. There is nothing like that is happening. If that is happening, then capital repair not allowed under 31. But it is a revenue repair. It's a current repair. You can claim that as a deduction. Okay. I hope it is clear to all of you. Adjustment number 3, very straightforward adjustment. You used to include interest in the interest cost in the closing stock till last year. So till last year, you used to make a mistake that you used to interest costs in the opening and the closing stock. But in the current year, you have changed the policy. You have done everything correct. And you have reduced the profit of the current year also. You have made all the rectification properly. So if you have done everything properly, then no effect. No need to do anything because you have done everything correctly now. So why do we have to give any effect? If they would have not done correctly, then we would have given any effect. Now, otherwise there is no need. Okay. Next adjustment number 4. One of your executive was on business trip. He died there. So one of your employee was on business trip. He died. So as a voluntary gratitude payment, you are making some payment of 2 lakh rupees to his family as a gratitude, out of courtesy, out of concern. So whether that can be claimed as a reduction, why not? The employee is dying on a business trip, not on a personal trip. Therefore, you can claim that as a reduction. There is nothing wrong in that. You can claim under 37(1). Okay. Next one, capital expenditure. You are incurring 1.8 lakh rupees on promoting family planning. So family planning promoting expenses are allowed only to company, first of all. Second, if it is a capital expenditure, it will be allowed 1/5. Therefore, you have to add back 4/5. You cannot add back, you cannot claim deduction of full 1.8 lakhs. You have to add back 4/5 of the 1.8 lakhs. Okay. Next one, you are paying some retrenchment compensation of 14 lakh rupees on closure of one of the unit. Now, I have told you the treatment of retrenchment compensation paid to the employees in the class. See, if you close the entire company and you pay retrenchment compensation, it is not allowed. So if the entire company is closed and now you are paying retrenchment compensation, it is disallowed. But if one of the unit is closed and if you are paying a retrenchment compensation, then that is allowed as a reduction. So this will be allowed as reduction because here one of the unit is closed, entire company is not closed. Next adjustment we have done earlier, you have taken some loan from a cooperative bank for working capital. So you have taken a working capital loan from a cooperative bank. Now the bank is waiving the principal and the interest both. So waiver of principal will be termed as remission and cessation of a trading liability. Therefore, it will be taxable. So let it be part of PGBP income. If a working capital loan is taken and if it is waived by bank, it is considered to be remission and cessation of a trading liability. Let it be part of PGBP income. What about waiver of interest? Waiver of interest will not be taxable. Why? Because it was not allowed as a deduction earlier on accrual basis. Interest is allowed on payment basis as per 43B because it was not allowed as deduction earlier. So now you cannot tax that also. I hope it is clear to all of you. Next one. You are contributing to some employees pension scheme. How much you are contributing? 12% of basic plus DA in terms you are contributing. So that's good. You can contribute up to 14% of basic plus DA in terms. You are contributing only 12%. So fully allowed. There is nothing wrong in this. Okay. Next one. There is a mark to market loss. This adjustment is coming for the first time, but it will come again and again from here onwards. There is a mark to market loss of 6 lakh rupees in respect of an unsettled derivative. Now what should I do? So generally mark to market loss is allowed as deduction under section 36 subsection 1 clause 18. But it should be as per ICDS, and ICDS says that only mark to market loss of settled derivatives will be allowed. Mark to market loss of unsettled derivative will not be allowed. Therefore, this 6 lakh will be disallowed. What about this mark to market margin? Margin is realized in the next year. It is not realized in the current year. Therefore, no effect in the current year. Next year we will see. And next year question we are not doing, we are doing question of current year. Okay. Next one, very routine adjustment. Provision for gratuity based on actuarial valuation disallowed as per 48(7). 40A7 does not allow provision for gratuity, but actual payment of 2.75 lakhs will be allowed as deduction. So you can claim 2.75 lakh as deduction and add back 4 lakhs. Next, some additional information is given. The assessee has invested in a private company in which assessee holds 16% shares. So if I hold 10% or more voting power in a private company is nothing but a closely held company, and if that company gives me a loan, that is deemed dividend in my hand under 222E, but the deemed dividend cannot be more than accumulated profits. So how much loan they are giving me? They are giving me loan of 4 lakh rupees, out of which the deemed dividend will be how much? The deemed dividend will be only 1 lakh because the accumulated profits are only 1 lakh. So 1 lakh will be taxable in my hand under income from other source. Next, I am giving some iPhone to my distributors, 5 iPhones of 60,000 rupees each. Total 3 lakh rupees iPhone I have given, but I have not deducted TDS. I should deduct TDS under 194R because I am giving benefit and perquisite in business. And if I give benefit and perquisite in business of more than 20,000 rupees, I should deduct TDS under 194R at the rate of 10% if the payee is a resident. I am not deducting TDS, therefore 30% of the expenditure will be disallowed because it is written in the question that this expense is already debited to the business promotion expense. You are already debiting this to P&L, therefore I will disallow 30% of 3 lakh, which is what? 90,000 rupees. And last but not least, you have contributed 3.5 lakh to approved electoral trust by RTGS. So this can be claimed as a deduction under 80 GGB. Okay. So this is what this question is all about. Nothing great. Yes, some adjustments were new, but it was very easy. Nothing great as such. Question number 2. Part A is very simple, but part A2 is very, very good. Part A. Mr. A, aged 34 years. He is a salaried employee. He is earning the following income. We need to answer what is the total income of this person. We need to compute total income, and he has not opted for 115 BAC, so we have to compute as per old regime. Okay. First, gross salary 23 lakhs from that old regime. Because old regime is following, we will take 50,000 standard deduction. Okay. Then business loss 4.5 lakh. You cannot set off against salary, therefore carry forward. Then short-term capital loss 3 lakh 60. Again, you cannot set off short-term capital loss against salary, therefore carry forward. Then you have purchased some bitcoins at 1,000 rupees, which is virtual digital asset, and you have sold for 1,300. Transfer expense not allowed. In case of virtual digital asset, transfer expenses are not allowed. So you have purchased for 1,000, you have sold for 1,300. Therefore 300 is the profit. That profit multiplied by number of bitcoins 1,000. That is 3 lakh rupees will be subject to tax at flat 30% tax plus cess. So the ultimate income will be 23 lakhs minus 50,000. Rest of the two losses carry forward, and this will be considered as taxable at flat 30%. I hope it is clear to all of you. Okay. Now the next question is a beautiful question. It will take time for you all to understand if you have not read this provision properly with me in class. We have done 3 circulars on this. That is the partnership firm provisions of 9B and 45.4. Let's go through the question first. There are 3 partners, L and MM, of a partnership firm since 1997. Now L retires from the firm on 27th of July. The capital account of L shows a balance of 20 lakh rupees. There is no revaluation of asset in the books of accounts after 2005-6. Now, so L is retiring. So if L is retiring from the firm, it will be called as reconstitution of the firm. And if there is a reconstitution of the firm, then 2 sections will apply. First, 9B will apply, and then 45.4 will apply. Now, what is the firm giving to partner? The firm is giving partner 3 things. One is cash, one is stock, one is land. So now we will apply 9B. 9B is applicable if there is a reconstitution of the firm and the firm gives capital asset or stock in trade to the partner. If stock in trade is given, then the firm will be liable for PGBP, and if capital asset is given, then the firm will be liable for capital gains. Now the firm is giving both. Capital asset is also given, stock in trade is also given. Let's talk about stock in trade. 9B. How will you compute the PGBP income? FMB of the stock in trade minus the cost. The FMB of the stock in trade today is 2 lakh rupees. What is the cost? 1.2 lakhs. Therefore, 80,000 will be chargeable under PGBP in the hands of firm, and therefore on that the firm will pay 31.2% tax. Then the firm is also giving to the partner what? Money. Money is not covered in 9B. The firm is also giving capital asset to the partner. Yes, that is covered in 9B. What is the market value of the capital asset? Land. The market value of the land today on the date of transfer is 17 lakh. The land was purchased for 60 lakh, but the FMB of the land was on 1/4/2001 was 1,10,000. Therefore, I will take 1,10,000 as the market value as the cost, because the asset was purchased prior to 2001. Therefore, 15.9 lakhs will be the capital gains in the hands of firm as per 9B. On that, the firm will pay 12.5% plus 4% cess, that is 13% tax. 9B is over. 9B, there are 2 tax they have to pay. Stock in trade, 80,000 into 31.2%. Capital gains, 15.9 lakhs into 13%. Now we will come to what? 45.4. What is 45.4? 45.4 is nothing but A is equal to B plus C minus D. That is 45 for capital gains. What is A, sir? What is A? A is your answer. What is B? B is your money received. How much money you are receiving? You are receiving 1 lakh money, so I am writing money 1 lakh. What is C? C is the market value of the capital asset received. What is the market value of the capital asset received? 17 lakhs. Minus what is D? D is the capital account balance. What is the capital account balance? It is 20 lakhs. But that is where most of the students will do mistake. Don't write 20 lakhs directly. First, you have to readjust the capital by adjusting the profit, book profit, by adjusting the accounting profit, and by adjusting the taxes. So first, you have to readjust the profit. How? What all things the firm is transferring to the partner as per 9B? The firm is transferring to the partner as per 9B stock, and then as per 9B, it is also transferring capital asset. It is transferring stock at what price? 2 lakhs. What is the cost of the stock? Cost of the stock. Is it revaluing? Yes. Check please. The stock is getting revalued at what? 80,000 rupees. So the book profit, accounting profit will increase by 80,000 rupees. What is the second thing that the firm is giving to the partner as per 9B? The second thing that the firm is giving to the partner as per 9B is land. Is the land getting revalued? No. Land is already valued at 17 lakhs and you are transferring the land at 17 lakhs. So for the land, there is no change in the accounting values. The accounting value is remaining same only. But for stock in trade, the accounting value is changing. The stocks were recorded at 120, but they are transferred at 2 lakh. Therefore, there is an increase of profit of 80,000 rupees in books of account. But for land, there is no increase in the profit. Therefore, there is only an accounting profit increase in case of stock. From this increased profit, they will pay 2 tax. 24,960, that is 31.2% on 80,000, and 13% on 15.9 lakhs, that is 2,06,600. So from 80,000 is the increase in the accounting profit, and there are 2 taxes they have to pay. So there is a net loss of 1,51,660. That will be shared between all the 3 partners, assuming that the share of profit is equal. So 1,51,660 divided by 3 will come to 50,553. So that is the loss which will be given to partner who is leaving the firm. That is partner N, whomsoever it is, L. So 20 lakh is the partner capital account minus 50,553 is the loss. So ultimately this difference is negative and this is positive. Therefore positive minus negative will come to negative. Therefore the loss is that if B plus C minus D is negative, then take as 0. So after doing all these things, ultimately we got the answer as 0. I hope it is clear to all of you. We have done 3 circulars based on this. Go and check with our question bank. Okay, I hope it is clear. Beautiful question it was. Question number B. There is a foreign company, XYZ INC, which is in Korea, which is entering into an agreement with an Indian company, XYZ Limited, and they want to provide some services with respect to setting up of a power plant in Gujarat, India. Now, they are providing some offshore services. Are the offshore services taxable? Yes, taxable. They are also providing some onshore services. Onshore services are also taxable. What do I mean by offshore services? Offshore means they are providing from outside India. Onshore means they are coming to India. Both of them are taxable because it is an FTS. It is a fees for technical services, and in case of fees for technical services, in case of royalty, in case of interest, it is not necessary that you should come to in India provide service. The services should be utilized in India. Yes, the services are utilized in Gujarat. That is sufficient. There is no need to come to India and provide services. Both of them are taxable. Therefore, this is taxable. Yes, this for offshore service they are charging 3 crore rupees. This 3 crore will be taxable. For onshore services, they are charging 2 crore. This 2 crore will also be taxable. But this 2 crore they are discharging by what? By way of debenture. This 3 crore they are discharging through bank account. But this 2 crore they are discharging by debenture. So they are providing us what? They are providing us onshore service, and in return we are giving debenture. So that 2 crore is also taxable, and interest on that 2 crore debenture will also be taxable for 7 months because the debentures were issued on 1st September. Therefore, 2 crore into 6% into 7 by 12, this will also be taxable. So in all, there are 3 incomes which will be taxable in the hands of ABC INC. One is onshore service of 2 crore, offshore service of 3 crore, and interest on debentures. All 3 of them will be taxable in India. They have only asked to discuss the tax implications. They have not asked to compute tax, so I am not computing taxation and all. I am just giving the treatment. What will be the treatment? I hope it is clear to all of you. Let's go to the next question. Question number 3. In question number 3, there is part A. Part A, very simple. There is a charitable trust which is providing some benefits to public. Apart from that, it is also giving interest-free loan to its employees. Now, the AO is saying because you are providing interest-free loan to your employees, employees are covered in 13(3) specified person. Therefore, I will withdraw your tax exemption. The answer is wrong. First of all, employees of the trust are not covered in the specified person definition. Employees are not covered. There is a case law of Tata Trust also, which is there in the first page of our textbook of taxation of trust. You can go and check over there also. And I have told you in the class also, I made you write separately that the employees of the trust are not covered in specified percent. Therefore, if you pass any benefit to the employees of the trust, it cannot be called as violation of section 13 subsection 3. Therefore, the AO cannot withdraw your tax exemption. He cannot withdraw because of this reason. Therefore, the AO is incorrect. Second question is a beautiful question of DTAA. Here you have to take two views. First of all, you are supposed to compute total income and tax liability of Mr. Rizvi, and you have to follow old regime. You have to keep this thing in mind first of all. Now, first of all, we will find out the residential status of Mr. Rizvi. Rizvi is an Indian resident, aged 35 years. He was working in Valley oil fields in country Sasa as a superintendent, and he was earning AED 9,500 per month. Now, his mother was not well. His mother is staying in Mumbai. She was not well. So he left everything and came back to Mumbai. He shifted to Mumbai on 1st of July 2025 permanently. Now definitely he is a resident because he is coming to India on 1st of July. So from 1st of July till 31st of March, obviously he is staying for 182 days or more. He is definitely resident. There is no doubt about it. But is he ordinary or not? There is a doubt about that. We don't have the data of the last 10 years. We don't know how many days he has stayed in the India for the last 10 years. For last 7 years, he was staying in India for how many days? I don't have that data. Therefore, we can assume both. First assumption we can take, he is an ordinary resident. The easy assumption we can take, he is a not ordinary resident. If he is an ordinary resident, then world income will be taxable. And if he is a not ordinary resident, then only income which is accrued in India, which is received in India will be taxable. Let's assume that he is an ordinary resident. Then world income will be taxable. Which all income will come? First of all, 3 months he was working there as a salary and he was earning salary there. That will also be taxable because for ordinary resident, world income is taxable. 9,500 into 3 months into what is the rate? 23. This will come. Then he has come, when he came to India, he has given his property on let out in his country at 3250. So when he came from July to India, from July he has given the property on rent. So 9 months rental income will also be taxable minus 30% standard deduction. Then business income in India will be taxable. Fixed deposit interest will be taxable. Saving bank interest will be taxable. Dividend income will be taxable. Yes, he can claim 80 TTA also as a deduction under chapter 6A because he is following old regime. And then you have to apply the tax rate in India, find out the doubly tax income, find out the average rate in India, and then apply the doubly tax income or average rate, whichever is lower on that. Okay, the tax rate in foreign country is 23%. Find out the tax, then it becomes a routine question. But the easier answer to assume is, let's assume that he is not ordinary. If he is not ordinary, then only income which is accrued in India, income which is received in India will be taxable. Therefore, salary income will not be taxable because it is accrued outside India. House property income will not be taxable because that is also accrued outside India. Business income will be taxable. Fixed deposit will not be taxable because that is also accrued in country. Yes, FD, saving bank interest can be taxable in India. Dividend income can be taxable in India, and then 80 TTA he can claim on saving bank interest. That's it. No double taxation, no double taxation relief, no need to find out average rate in India, nothing to do. Because there is no double taxation only. Now, only Indian incomes are taxable. The double taxation cannot happen only. Therefore, it is very easy to make this assumption. Therefore, the answer to this question is very long. In first assumption, they have taken everything. They have found average rate in India, which is 21.25. Then they have compared that with foreign rate, whichever is lower. In second assumption, very simple, nothing will get taxed, only business income in India, SBI interest this, and then 80 TTA deduction you can claim, and then 1 or 2 mediclaim deductions are also there that you can claim, you can check. 48,000 and 60,000 he has incurred for his father and himself, etc. That you can claim as a ATD deduction. That's it. So whatever assumption you want to make, you can make. Okay, that is your choice. Let's move to the next question, question number 4. Which is on TDS. There are 2 questions on TDS, and then there is a transfer pricing question, question number 4A1. Now, what is this particular question all about? Good question. There is a person who is providing me what? Technical consultancy. So, if a person is providing me technical consultancy, let's assume that it is fees for technical service. I have to deduct TDS at the rate of 2%. But the other person is going to assessing officer and getting a lower deduction certificate of 1%. And is giving that certificate to me. Then I have to deduct TDS at 1% only. Generally, I have to deduct TDS at 2%. If it is a technical service, then 2%. If it is other professional service, then 10%. But if the payee is going to assessing officer and getting a lower deduction certificate, giving it to me, then I have to deduct TDS at 1% only. I hope it is clear to all of you. Second question, very simple. I am purchasing a house of 60 lakh rupees. The stamp duty value of the house is 82 lakhs. So therefore, I will deduct TDS at the rate of 1% on whichever is higher under 190 for IA. So therefore, the consideration is 60 lakh, but the stamp duty value is 82 lakh. Therefore, I will deduct TDS on 82 lakhs, 1% TDS. I hope it is clear to all of you. Next question is a question on transfer pricing. Good question, but simple question. But it's a good question. We are supposed to compute arm's length price in point number A. Now let's try to understand who are the associes over here. There is a Shahi Private Limited, which is an Indian entity, and there is a Sumi INC, which is a Japanese entity, and the Indian entity is wholly dependent on the raw material of the Japanese entity. So if the Shahi Indian entity is wholly dependent on the raw material of Sumi Japan, then both of them are deemed to be a source enterprise. Why? Because if one enterprise is dependent on other enterprise 90% or more for raw material, then both of them are deemed to be a source enterprise. Here it is not 90%, here it is 100%. Therefore, both of them are deemed to be a source enterprise. Now, Shahi is importing goods of 30 crore. Now, we need to find out the arm's length price of this. Now, there is some mathematical game which we need to understand over here. You are purchasing goods of 30 crore from Sumi. So, this is your price which you are paying to Sumi. This is your purchase price. On that, Sumi is charging 20% markup to you. Markup is always on cost. So, if it is 20% on cost, that is 1/5 on cost. But 30 crore is not cost for you, it is sale for you. So it will be 1/6 on sale. Therefore, the cost will be 1/6 profit I have to remove from here. 30 crore, 1/6 will come to 5 crore. Therefore, the effective cost for Sumi will be 25 crore. So Sumi's cost is 25 crore plus Sumi is charging profit of 1/5 of cost, that will come to 30 crore, and 1/6 of sale, that will come to 30 crore. Therefore, the cost of Sumi is 25 crore. So Sumi is charging us more margin. We don't want this margin, we want arm's length margin. The arm's length margin with respect to unrelated party is 10% on cost. Therefore, now I will apply 10% on the cost. So first I will find out the cost of Sumi. On that I will apply 10% cost, 10% margin. I hope it is clear to all of you. Because 30 crore is the selling price. I will reduce the profit from that. Then I will get the cost. On that I will apply arm's length margin. Arm's length margin is 2.5 crores. So now ultimately the selling price is coming to 27.5 crore. Now, Sumi is providing me one more services. Sumi is providing me to use the brand name of Sumi without any payment. For that, the annual cost of the brand value is approximately 90 lakhs. So that also Sumi will charge me. Obviously, Sumi will not give me to use that brand value without cost. Obviously, they will charge some money. So they are charging 90 lakhs. So I am adding 90 lakhs, 0.9 crore to this. Therefore, ultimately, the final price, the actual arm's length price should have been 28.4. But how much we are paying? We are paying 30 crores. Therefore, differential amount should be added back. That is the amount of arm's length price which will be added back. Now, part 2. If the TPO increases the income, suppose TPO increases the income by 2 crore. TPO further increases the income by 2 crore. Can I claim deduction of 10AA on 2 crore? No. You remember that? If the officer increases the income, then on increased income, you cannot claim Chapter 6 deduction and 10AA deduction as per 92C subsection for first proviso. As per first proviso to 92C subsection 4, if the AO or TPO increases your income, then you cannot claim what? You cannot claim 10AA or Chapter 6 deduction on that. I hope it is clear to all of you. Third one. Will Shahi Private Limited become liable for penalty for under-reporting of income based on the report of the transfer pricing officer? No. See, 270A penalty is imposable when if you don't report the transaction in Form 3CB and if you don't maintain proper documents as per 92D. Now, it is nowhere mentioned in the question anywhere that the Shahi is not maintaining documents, Shahi is not reporting in the transaction. It is nowhere mentioned anywhere. So, if you don't do this, then directly 200% penalty is impossible on you as a misreporting of income. But if you maintain documents properly, if you report Form 3CB properly, then the penalty under 270A will not be imposed on you. Therefore, unnecessarily, we will not impose penalty on this particular assessee. So, this is what this question is all about. Now, let's go to the next question. Beautiful question. 3 case laws are there. First case law has now become an amendment. What is the first case law? I will tell you the background of the first case law. There was an assessee who has deducted the TDS, but he failed to pay the TDS on time by 7th of the following month. But he has rectified his mistake before the date of filing the TDS returns. So, for example, for the month of April, you have to pay the TDS by 7th of May. So, he did not pay by 7th of May. But before 31st July, before filing the TDS returns, he has paid the TDS. He has paid the interest and he has filed the TDS returns also. Still, the assessing officer has imposed penalty. Assessing officer has imposed prosecution proceedings against the assessee. So the Supreme Court of India said that you cannot do that. If the assessee has suo motu rectified the mistake, paid the tax, paid the interest, filed the TDS returns on time, then you cannot impose what? Prosecution proceedings. So the CBDT liked that judgment and CBDT made that as a law. The CBDT passed an amendment in 2024. And the amendment was that if an assessee has failed to pay the TDS on time, but he has paid the TDS before the filing of TDS return, and he has paid the interest also and he has filed the return also, then you cannot impose prosecution against him. Initially in Finance Act 2024, they made this amendment for TDS, but in Finance Act 2025, they made this amendment now for TCS also. So for TCS also, if you fail to pay the TCS on time, but you rectified your mistake before the due date of filing the TCS return, you paid the TCS, you paid the interest, you filed the return, then nobody can impose any prosecution against you. I hope it is clear to all of you. Second question. Second question was, there was an assessee who has initiated some MAP proceedings under DTAA between India and foreign country. What is MAP proceeding? Mutual agreement proceedings. You know that if you are covered under DTAA and there is some wrong thing happened against you, which is not as per DTAA, the taxation of the assessee is not as per DTAA, then you can approach the competent authority of your nation. Then the competent authority of India will talk to the competent authority of foreign country. They will try to resolve the matter through MAP proceeding. The tribunal can also come in between. International arbitral tribunal may also come in between to resolve the issue. So there was something like this which was pending in case of assessing. So this is one of the proceeding which was going on. Now at the same time, the assessing officer is imposing interest under section 220, declaring the assessee is assessee in default. Because assessee might have done some violation. Now the assessee is making argument, because my MAP proceeding is already pending, you cannot initiate a proceeding, any other proceeding under the income tax law against me and declare me as an assessee in default. So the matter went to Supreme Court. The issue under consideration is, if MAP proceeding is already pending at international level, can the assessing officer in India can initiate other proceeding? The answer is yes. The Supreme Court said that MAP proceedings and the assessing default proceedings are independent of each other. They have nothing to do with each other. If we make a conclusion like that, if MAP proceeding is pending, the AO cannot do anything else, then everybody will deliberately start with a MAP proceeding, so that the AO cannot touch you. Therefore, MAP proceeding is independent and all other proceedings are independent under the income tax law. I hope it is clear to all of you. Beautiful case law. Now, again a beautiful question on section 911, business connection and significant economic presence. What is a significant economic presence? If a non-resident is doing transaction with a resident for any goods, services, and if the payment is exceeding 2 crore rupees, then that amounts to business connection. The non-resident has to do transaction with resident. Then the transaction will be subject to business connection. It is significant economic presence and it will be taxable in India. It will be deemed to accrue or rise in India. So let's try to understand what is exactly happening in this question. Kiwi Inc. is a company which is engaged in manufacturing and selling of mobile phones globally. So they are selling mobile phones across the world. One mobile phone is sold for $2,000. Alpha Inc. is another company based in USA which is having a website like Amazon. So Alpha Inc. is working like Amazon. It's an e-commerce operator. Gamma LLC is a company incorporated in UK. They are engaged in manufacturing and selling of printer. So there are three entities. One is Kiwi, which is selling mobile phones. One is Alpha, which is running like a e-commerce operator. One is Gamma, which is engaged in manufacturing and selling of printers. Now, Kiwi is selling 80,000 mobile phones. How? How and to whom? Both the questions are important. Three questions are how, to whom, and how much. It is selling through Alpha. That is through a website. Okay. To whom? To a person resident in India, taxable. Now we need to check if it is crossing 2 crore, then significant economic presence is there. 15,000 mobile phones into $2,000 into what is the rate of dollar over here? It is 80 rupees into 80 rupees. It is definitely crossing 2 crore, therefore it is taxable. Because you are selling to Indian residents through a website, therefore it is taxable. It is deemed to accrue rise in India. Second, you are not selling to Indian residents, therefore not significant economic presence. Third, again you are selling to residents through your own website. That is also taxable. to your own website. Your website is outside India, but you are selling to Indian resident. That is deemed to accrue or rise in India. Again, 7,000 into $2,000 into 80 rupees. It is crossing 2 crore. Fourth one, again you are not selling to resident, therefore not taxable. Fifth one, you are selling to resident, but through a physical store in US. This will not be subject to tax. This is very common sense here. You are going to UK or you are going to US and doing some shopping over there in a physical store. So whether that physical store will come to India to pay tax in India? Obviously no. Obviously no. This is not applicable to the physical stores which are there. This is only for digital transactions. Significant economic presence. This will not be subject to tax. Now one more transaction is there. Gamma LLC enters into a contract with Alpha for publishing an advertisement on the website for the period. Now the Gamma paid $50,000 for advertisement in India for Indian customer deemed to accrue rise in India. I've told you in the class, remember, if Samsung is telling Facebook that do advertisement for me, now the Facebook is asking Samsung, which is your target customer? If your target customer is India, then that advertisement income is deemed to accrue rise in India. But if your target customer is UK, then that advertisement income will not be deemed to accrue rise in India. So this 50,000 is targeting Indian customer, therefore it is taxable. This 20,000 is targeting advertisement in UK, therefore this will not be subject to deemed to accrue rise in India. I hope it is clear to all of you. And one last question over here, which is on this last question is on SFT reporting. Whether the following transactions will be reported in SFT by the reporting entity or not, we need to answer this. Let's see. First, Mr. A is purchasing 5 bank drafts of 3 lakh each from a current account with State Bank of India. No, it will not be reported. If you purchase a bank draft of 10 lakh or more, it will be reported by the bank only if you purchase in cash. Here you are not purchasing it cash, you are purchasing in online mode through your current account, therefore it will not be reported. Second transaction. You are making 2 time deposits, one of 7 lakh, one of 5 lakhs, total 12 lakh. It will not be reported. Why, sir? Time deposit of 10 lakh or more if you make, then it will be reported in SFT. But the renewal is not covered in 10 lakh. Fresh 10 lakh is covered. 7 lakh is fresh. 5 lakh is renewal. This will not be covered in 10 lakh limit. Therefore, only 7 lakh FD is made for the purpose of SFT. Therefore, this will not be reported. Third, credit card. Credit card transaction will be reported when? If the credit card bill is paid in cash of 1 lakh or more, or the total credit card bill of the entire year by any mode is 10 lakh or more. Now, the cash payment is 19,500 each month in cash from April to July for 4 months. Now, this is not exceeding 1 lakh. Wait. But one more cash payment is made. Check from Jan to March. Now, if I take the first and the third transaction, the cash payment is exceeding 1 lakh. It is 1 lakh or more. Therefore, the first transaction will be reported, third will be reported, second will not be reported because second is made through online payment and therefore that will not be reported because for online payment, the limit is what? The limit is 10 lakh and it is not crossing 10 lakhs. The first and the third transaction will be reported, the second one will not be reported. And last but not least, if I am a assessee who is subject to tax audit, and if I sell any goods or provide any services, and if I receive more than 2 lakh rupees, in cash, not exactly 2 lakh, more than 2 lakh in cash, then SFT is required. If it is exactly 2 lakh, then SFT is not required. In this case, check, it is exactly 2 lakh, therefore no SFT. I hope it is clear to all of you. Very minute thing they ask in examination. If it is, go and check the SFT limit. For tax audit assessee, if they sell anything and receive more than 2 lakh, then SFT is required. It is exactly 2 lakh, SFT is not required. Whereas, if you receive exactly 2 lakh, SFT is not required. But 269 ST penalty will be imposed on you because in the provision of 269 ST, and 271 DA penalty, the limit is exact 2 lakh. But for SFT, it is more than 2 lakh. See that inconsistency between the law. I hope it is clear to all of you. Check it, please. So this is what this beautiful paper is all about. Check it, please. Then we will go ahead with the next paper. Let's move on to the next paper, that is November 2023 paper. The very first question is of a domestic company. We are supposed to compute what? We are supposed to compute the book profit and the minimum alternate tax. Ignore the provisions of normal tax. Okay, just book profit and all and MAT we have supposed to compute. The net profit of the assessee is 89 lakhs. The first expenditure is expenditure pertaining to 10AA. Now the expenditure pertaining to 10AA are not added back. They are subject to MAT. So let it be like that only. Don't do anything. Next, depreciation as per Companies Act. What happens with depreciation as per Companies Act? You add back depreciation and then you reduce other than revaluation. In this question, there is no revaluation. Therefore, add back 30 lakhs and reduce, add back 34 lakhs and reduce 34 lakhs. There is no revaluation in this question. Therefore, you can do two things, write a note or you can add 34 and less 34. Both the answers are correct. Next, interest to financial institution not paid. It doesn't matter. In a MAT, it does not add back. Penalty for infraction of law, it doesn't matter. In MAT, it is not added back. In normal provision, it is added back. Then proposed dividend add back, provision for income tax add back, transfer to general reserve add back, and then expenditure pertaining to ATIA do not add back. It is a part of MAT liability. Okay, let it be part of MAT. Okay. Next one is a very intelligent adjustment, which is credit to the statement of penal account. Amount withdrawn from reserve created during 22-23. Generally, if you withdraw an amount from reserve and credit to PNL, you should reduce from book profit. But in this case, I will not reduce because the book profit of 22-23 was not increased by such reserve. It is very clearly written in the law that you can reduce from the book profit only if the book profit of earlier year was increased by such reserve. Now, if that was not increased by such reserve, you cannot reduce that. I hope it is clear to all of you. Next, profit from 10AA, let it be part of MAT. MAT is applicable on 10AA. Profit from ATIA, let it be part of MAT. MAT is applicable on ATIA. Deferred tax credit, you can reduce. Deferred tax credit is not subject to MAT, so you can reduce that from book profit. Last but not least, you have a business loss as per books of 8.75 lakhs and you have an unabsorbed depreciation as per books of accounts 0. Whichever is lower is 0. Therefore, nothing will be allowed as deduction. The rest of the three items are not eligible for MAT. That they are not relevant for MAT. They will be helpful in calculating the provisions of tax as per normal provision. And in this question, we are not computing tax as per normal provision. We are computing only as per MAT. After that, apply 15% tax. Apply surcharge if applicable. If not applicable, ignore. Then 4% cess will apply. As simple as that, a very simple question. Question number B1. What is there in this question? There is an airline company, okay, which is incorporated in USA, foreign airline company, US airline company, which operates flights from India to US, US to India. So now we have to compute the total income as per 44 BBA. Now 44 BBA is applicable to non-resident aircraft business. When it is applicable, when the aircraft is leaving India, then it is 100% taxable in India. But when the aircraft is leaving from outside India, then it is taxable only if it is received in India. Okay. Now, they are first of all earning 90 lakh rupees for carriage of passenger from Delhi to New York and vice versa. But out of that 90 lakh, it is from Delhi to New York, New York to Delhi, total 90 lakh. But out of that 90 lakh, 40 lakh is received in New York for passenger from New York to Delhi. So out of 90 lakh, 40 lakh is from New York, therefore it is accrued outside India, and it is also received in New York, therefore it is received outside India. Therefore, out of 90 lakh, 40 lakh will not be subject to tax, only 50 lakh will be subject to tax. Similarly, out of this 70 lakhs, 30 lakh is same only. It is received in New York from flight flown from New York. The flight is also leaving New York, received also New York. Therefore, out of 70 lakh, 30 lakh is accrued outside India, received outside India. Therefore, only 40 lakh will be taxable in India. So, 50 plus 40, total revenue is 90 lakhs. Of that, 5% will be deemed income. 5% deemed income will be taxable in India, but from 5% deemed income, you will not get deduction of any expenses of PGBP because under 44 BBA, PGBP expenses are not allowed as deduction. Therefore, this 170 lakhs will not be allowed as deduction. You should write that as a note in the examination, otherwise you will not get complete marks. Okay. Next question, Mr. Adi. Here you can take two views in this question. Mr. Adi is a non-resident Indian. He is an NRI. He is purchasing some unlisted equity shares of 6 lakh rupees and he is selling that from 9 lakh rupees. Brokerage transfer expenses of 15,000 rupees. Now you are supposed to compute taxable capital gains of Adi. Ignore first proviso to 48. Don't consider first proviso to 48. Assume that Adi has invested in the specified assets before 31st March. Now you can assume two things. Adi has purchased the shares in foreign currency. See, how Adi has purchased the shares, that is not given. Whether Adi has purchased the shares in foreign currency or Indian currency, I don't know. If he has purchased the shares in foreign currency, then Adi can apply Chapter 12A. What he can apply? Chapter 12A, and he can claim exemption for what? This 3,50,000 reinvested. But if Adi has not applied for, if Adi has not purchased the shares in foreign currency, but he has purchased the shares in Indian currency, then he cannot apply Chapter 12A and he cannot claim exemption of this 3,50,000. Let's assume both the things. Institute has assumed both the things. Let's assume that Adi has purchased the shares in foreign currency. Therefore, sale consideration 9,15,000 transfer expenses, net consideration very important 8,85,000 and 6 lakh rupees cost. 2,85,000 is your capital gain. Now, if you want to save this capital gains, you can invest 8,85,000 in specified assets within 6 months. But Adi has invested only 3,50,000. Therefore, he will get proportionate exemption, that is 2,85,000 capital gains multiplied by amount invested divided by net consideration. This much Adi can claim as an exemption. This answer is correct if you assume that Adi has purchased the shares in foreign currency and is going for Chapter 12A. He is opting for Chapter 12A. Then only this exemption is allowed as per 115F. But if Adi has purchased the shares in Indian currency, then the answer is very simple. Adi cannot get this exemption. Therefore, ultimately, Adi's capital gains will be 2,85,000. As simple as that. You don't have to think much. I hope it is clear to all of you. Next question, question number 2 is a very simple question on DTAA. You can do it or you can ignore it. I will say you can ignore it. Don't waste much time. We have done much better questions on DTAA earlier. So there is no need to do such kind of hopeless question once again of DTAA. Ignore that question completely. There is no use of doing that question once again. Okay. Question number 3 we will come to. If there is some absolute repetition, I will not do that. Even if there is 1% change in the question, I will try to do that with you all. But if it is absolutely same to same, then it doesn't make sense to do it once again. Next question is on TDS and TCS. Mr. Kunal is an employee. Employee of what? Of an engineering company, Vertex Engineering Private Limited. He has taken a loan of 11 lakh from employer for his son's education in Germany. But out of that, he has remitted only 9,15,000 rupees. So, if you take a loan from your employee, then TCS is definitely applicable, but up to 10 lakh rupees, it is exempt. Above 10 lakh rupees, it is taxable. Taxable at what percent? 5%. So, if you take a loan from employee, if you take a loan from a financial institution in India and then you send outside India, then TCS is not applicable only. But here you are not taking loan from a financial institution, you are taking loan from your employer. So, you are taking a loan from your employer of how much? 11 lakh rupees. You are sending 9,15,000. This will not be subject to TCA. Now, you are sending, this is for your son's education. Now, you are sending another 6,98,000 rupees for his out-of-pocket expense, which is also considered as education expense only. Now, this will be subject to what? TCS, but only in excess of 10 lakhs. So, total how much you have sent? 915 plus 698. Total you have sent 16,13,000 rupees. So, out of 16,13,000, remove 10 lakhs. On 6,13,000, 5% TCS will be applicable. I hope it is clear to all of you. Is it clear? I hope it is clear. Next question, Mr. Rajat Kapoor, who has a turnover of last year 18 crore rupees turnover. Therefore, he is definitely last year turnover is too high. Therefore, now he is purchasing a residential house of 7.5 crores. First of all, he will deduct TDS under 194 IA at the rate of 1% on selling price or stamp duty value, whichever is higher. Selling price is 7.5 crores, stamp duty value is just 4.5 crores. Therefore, TDS will be applicable on 7.5 crore. 1% TCS will come to 7,50,000 rupees. Mr. Rajat has to deduct and pay. Second, Mr. Rajat is also paying 13% commission on purchase of house. So 13% commission on 7.5 crores comes to around 97.5 lakh. So now, last year's turnover of Mr. Rajat is more than 1 crore, yes, and Mr. Rajat is paying commission of 97.5 lakhs. Therefore, Mr. Rajat will be liable to deduct TDS at the rate of 2% under 194H, not under 194M. Sorry, I've wrongly written under 194H, and the answer it is 194H only. Why Rajat will deduct TDS under 194H, sir? It is personal commission. 194H covers personal commission and business commission, both kind of commission. Go and check. 194C and 194J does not have personal things, but 194H definitely covers personal commissions also. Therefore, Mr. Rajat will deduct TDS under 194H only. I hope it is clear to all of you. Third question we have already done. You can check it later on. I am not repeating and not doing time waste on that. Okay. Let's go to the next question, which is on case law. Some good case laws are there. First question. Very long story. I have to tell you the story by reading the question one by one. There is an assessee who has filed e-return with an income of 11,75,000. In the return, he has shown two income exempt, one PPF interest exempt and one long-term capital gain exempt under 1037. He has shown both this in the income tax return as an exempt income. But he failed to claim the business loss of the current year, 4,50,000. He failed to claim that. So 2 exemption he has claimed, 1 loss he failed to claim. After a few months, what happened? The return got processed and the return disallowed both this exemption also. The return disallowed the interest on PPF also, the return disallowed long-term capital gains also. Both of them are disallowed. And the intimation was served to the assessee. Then the assessee filed a revised return under 139(5), but again he made a mistake. He did not e-verify the return within 30 days. When you file a revised return or when you file a normal return, whichever return you file, you have to e-verify within 30 days. You have not done e-verification within 30 days. So I will tell you the entire story. First, he has filed the return. He has claimed 2 exemptions. Third, he has failed to claim the business loss. Now the software has added back 2 exemption also. Then he filed a revised return but did not e-verify, so there is no use of that revised return. Now he is making a rectification application and telling the assessing officer to rectify both the exemptions also, and he's telling the assessing officer to allow business loss also. So whether the assessing officer will allow or not, the rule is very simple. What does 154 say? If there is a mistake apparent from record in the intimation, I will rectify. See, there is a mistake apparent from intimation as far as what is considered. As far as your 2 interest and long-term capital gains are considered, the intimation has done a mistake by disallowing that. You have claimed intimation, you have claimed interest, you have claimed LTCG in your ITR, but software has added back. That is a mistake apparent by software. But the business loss you have not claimed only in the return. So how can you tell that business loss to get rectified? That will not be rectified by the assessing officer. So the assessing officer will rectify something which is a part of the return. Assessing officer will not rectify something which was never a part of return. Therefore, the assessing officer will not rectify the business loss, but he will rectify the first 2 things. I hope it is clear to all of you. Second question is also a case law. What does this case law say, sir? Pay attention, please. Very, very good case law. See, in 269SS and 269T, you cannot take a loan of 20,000 or more in cash, and you cannot repay the loan of 20,000 or more in cash. Cash means other than 4 modes you cannot do. Account pay check, account pay draft, ECS and such other electronic mode. Otherwise, the assessing officer under 271D and the assessing officer under 271E will impose penalty on you and will give you an opportunity of being heard. Will give you an opportunity of being heard and will impose penalty. Now the question is, this assessee has repaid the loan by passing book adjustment, by passing book entry. I have to pay you 3 lakh, you have to pay me 3 lakh, so we have adjusted. I have to repay 3 lakh loans and you have to pay me 3 lakh, so we have adjusted. Now the officer is saying that this book adjustment is other than 4 modes, therefore I will not allow. Therefore, I will impose penalty under 271E. This is a violation of 269T. So the court said that the power to impose penalty is on assessing officer, and assessing officer has to give reasonable opportunity of being heard before imposing the penalty. And if the assessing officer finds the transaction bona fide and genuine, there is no tax evasion or tax avoidance, then he should allow this mode also other than 4 modes. Otherwise, what is the use of giving opportunity of being heard? Therefore, passing the repayment of loan by book entry is also allowed. No penalty will be imposed if the transaction is genuine and bona fide. I hope it is clear to all of you. It is not necessary that you should make the payment by 4 modes only. You can make the payment by other than 4 modes also. You provided you prove that it is a genuine transaction. There was no intention of evasion of any tax. Third one is also a very good case law. The assessee is engaged in business of leasing. So assessee does what? Assessee purchase capital equipments like cars and other machineries and then give that on lease to the customers. Now, so to give one of the capital equipment on lease to customer, the assessee has taken foreign currency loan. On that foreign currency loan, there is lot of forex loss which is coming on that particular loan. Now that forex loss is claimed as a deduction by the assessee under PGBP. Now the officer is saying no, you cannot claim that as a loss as a loss in PGBP. You have to add that to the asset and claim that as a depreciation. So the matter went to the Supreme Court. The Supreme Court said that no, it will be claimed as a business loss only. Assessee can claim that as a business loss because taking loan is an independent transaction and giving the property, giving the asset on lease is an independent transaction. Don't mix both of them. Both of them are independent of each other. Both of them are not related to each other. Therefore, because both of them are not related to each other, both are independent of each other. Therefore, business loss will be allowed as a separate deduction. Do not add to the cost of asset. This is what it is given in this particular case law. And one last question is a very, very simple question. Very simple question. Whether the following assessees are liable to file the income tax return or not. See, there is an assessee who is incurring 2.4 lakh rupees on travel to foreign country for his wife. Yes, if you incur more than 2 lakh rupees for a foreign country travel for yourself or any other person, more than 2 lakh rupees if you incur for yourself or any other person for travel for to foreign country, you are liable to file the return. Similarly, if your turnover of the business is more than 60 lakh rupees, then you are liable to file the income tax return. So your turnover in this case is 73 lakh. Therefore, you are liable to file the income tax return. And one last question is a theory question. You can go through it once if you want. Okay. Just check it once, then we'll go ahead with the next paper. Let's go ahead with the next paper, that is May 2024 paper. Very first question over here is on total income. We are supposed to compute total income as per the normal provision, not as per 115BAA or BAB. Okay, so let's start. There is a pharma company which is having a net profit of 95 lakhs over here. The net profit is 95 lakhs. So first write down that. Depreciation as per books of accounts, you add back 11.9 lakhs. Now, adjustment number 2 is a good adjustment, which is on a Supreme Court judgment of Sashun Chemicals Limited, which we have done in 43B in PGBP. Now, what is this judgment? Now, what is the assessee done? Assessee has some dispute with the employees going on with respect to bonus payments. So, there is a case which is going on in the court. So, for the time being, what assessee has done? Assessee has put the money of the bonus in what? In a separate account, in a trust. They have made one trust and they have put the money over there, because we know that the deduction of bonus to employees are allowed on what basis? Are allowed on payment basis. Okay, just a second. There is some, not see the video. Yeah, it has come back. So what I was saying, that assessee was having some dispute with the employees. So till the time the employees dispute is not settled, so he has put that money of bonus in what? In a separate trust account. Now the dispute got resolved before the due date of filing of return, and the assessee has removed the money from the trust and paid to the employees. Everything has been sorted before due date of filing of return. Now the assessing officer is saying, no, you have not directly paid the amount to the employees. You have first given to the trust, and then the trust is giving to the employees. Therefore, I will disallow the expenditure. There is nothing wrong in this. The Supreme Court said that so far as the money has reached to the employees before the due date of filing of return, therefore the assessee should be allowed the deduction of this particular expense. I hope it is clear to all of you. Next one, the assessee is paying some regularization fee for violating the medical council law. So if you pay some money for violating a law, then that is disallowed because it is penal in nature. It's a penalty for breaking a law. It's an illegal expense as per explanation 1 to 37.1. It will be disallowed. Next one, you are paying 45,000 rupees as a late fee to the government for not completing the contract on time. Now this 45,000 which you are paying for not completing the contract on time, it's compensatory penalty. Therefore, it is allowed under the income tax law. I hope it is clear to all of you. Next one, again a routine adjustment, 100% holding subsidiaries selling each other. Therefore, it is fully exempt. So reduce from here and show exempt under what? Under capital gains. Nothing great as such. Next one is also a very routine adjustment of grandfathering, that whenever 31st Jan 2018 will come, grandfathering is applicable. So here you will remove this profit from of 4.5 lakhs from PGBP, and you will compute as per the grandfathering clause the profit as per the grandfathering clause. But the only thing which you need to keep it in mind over here, when you take the FMV as on 31st Jan 2018, you have to take the highest of the market value on 31st Jan 2018. In this question, they have given you two market value, one 175, one 165. Don't take 165. You have to take the highest of the market value. That's the only catch in this question. Otherwise, this is again a very, very simple adjustment. Next, point number 7. You are supposed to pay some tax liabilities to the GST department or other tax departments, but instead of paying the tax, you are giving bank guarantee to the department. Whether giving bank guarantee amounts to actual payment? No. Giving bank guarantee does not amount to actual payment. It will be disallowed. Actual payment, it means it should reach to the authorities. Only giving a bank guarantee does not amount to actual payment. Next, you have taken some loan 3 years ago on which there is an interest of 7.5 lakhs. You have deducted the TDS on time before March, and you have paid also before July, before the due date of filing of return. So nothing will happen. This will be allowed because it is deducted on or before the end of the year, and it is paid before the due date of filing of return. Therefore, it will be allowed as a deduction under the income tax law. Just write a note that this is allowed as a deduction. Next one, the company has contributed 65 lakhs to electoral trust by account pay check. So add to PGBP, and donation given to electoral trust will be allowed as deduction under 80 GGB. I hope it is clear to all of you. Now the next adjustment is a very, very, very intelligent and very good adjustment. Be very careful with this adjustment. Okay, the company has imported some machinery parts. What they have done, they have imported some machinery part, but by mistake they have included that in the closing stock. How much machinery parts they have imported? 1200 pieces they have imported, but by mistake they have included that in the closing stock. So what should I do? Don't do anything. Why, sir? because it will get nullified. Sir, how? See, if you have imported the machinery part and by mistake you have shown in the closing stock, so by mistake you would have shown in the purchase also, because you have considered that as a raw material, correct? That's the reason you are showing in the closing stock now. So if you have by mistake considered as a purchase and by mistake considered as a closing stock also, so you would have gone it would get nullified. Therefore, there is no need to give any effect. I hope it is clear to all of you. Yes, but one thing you have to do is no effect in P&L. But you should add that to plant and machinery and claim normal and additional depreciation on that. So yes, that you have to do. 1200 pieces because it's a part of machinery now. So you should claim normal and additional depreciation because you are a manufacturer. So 1200 pieces into $25 per piece into 82.88, because on 15 September when you have purchased, on that date the dollar rate was 82.88. So on that you can claim normal and additional depreciation. I hope it is clear to all of you. Now apart from that, the adjustment number 2 in the additional information. The depreciation charge in the statement of P&L is 11.9 lakhs. So this is your depreciation as per accounts. So add back this and then take depreciation as per tax. The first thing over here is you are purchasing some firefighting equipment of 95,000 rupees. But the question is saying that there was no fire and hence equipment was not used. So what? Firefighting equipments are not necessary that fire should be there. You are using that as an emergency. Therefore, keeping a firefighting equipment in your factory, in your office itself is a passive use. Therefore, you can claim depreciation on that. There is nothing wrong in this. You can claim depreciation. There is nothing wrong in this. Second, additional depreciation you cannot claim because it is in office. New machinery which is installed, on this you can claim additional depreciation also, normal depreciation also, because it is new machinery which is installed. You can claim normal depreciation 15%, additional depreciation 20%, and you can also claim what? Normal and additional depreciation on this particular closing stock also, imported machinery spares. Third one is very good adjustment. In 2018, you have sold some machinery whose WDV at that time was 35 lakhs. Now you are purchasing that machinery back for 65 lakhs. So do you remember? If you sell an asset and reacquire, then the actual cost of the asset will be determined as per explanation 4 to 43.1. That is the WDV at the time of original transfer or reacquisition price, whichever is lower. Now the WDV at the time of original transfer was 35 lakhs. And reacquisition price is 65 lakhs, whichever is lower will be considered to be actual cost. So therefore, you will get 15% normal depreciation on this. Additional depreciation will not be allowed because it is second-hand plant and machinery. I hope it is clear to all of you. On second-hand machinery, additional depreciation is not allowed. So this is what this question is all about. One or two adjustments were very good. Otherwise, it was a very routine adjustment, routine sum. Now, coming to question number 2, very simple question. There are three parts in this question. First part, Mrs. Urvashi, who is 56 years old. She is a resident. She is individual. She acquired a residential house at Ayodhya in 1994 for 45 lakhs. The market value of the house on 1/4/2001 is 1 crore 20. Stamp duty value is 1 crore 2 lakhs in 1/4/2001. Now she is selling the house on 15th of October for how much? 15 crore 50 lakh rupees. The stamp duty value is 70 lakhs. So which value I should take as an FVC? You will take 15.5 lakh crore as FVC. Why, sir? Because the difference between the FVC and the stamp duty value is not more than 110%. You can take 110% of 15.5, it is not exceeding that. Because the difference is not more than 110%, therefore, you will take full value of consideration as your selling price. Selling price will be 15.5 crores. Sir, what will be the cost of acquisition? See, the cost will be actual cost is 45 lakhs. Compare with lower of stamp duty value and market value is on 1/4/2001, whichever is lower. So the lower is 1 crore 2 lakhs. Ignore this market value. Now we will compare this with what? Compare this with actual cost. Now whichever is higher, therefore 1 crore 2 lakhs will become your cost. So therefore, what is your sale consideration? Your sale consideration is 15 crore 50 lakhs and your actual cost is 1 crore 2 lakhs and 14 crore 40 lakhs will be your capital gains. This is long term obviously because it is 24 months old. Now to save this long term capital gains on this Ayodhya house, Ayodhya is also house over here, residential house over here at Ayodhya. You are purchasing another residential plot in Amritsar and you will be constructing a house in the next 1 or 2 years. So you are depositing 3 crores in the capital gain account scheme. So total you are reinvesting 11 crore. But remember, you will get exemption under 54 of only 10 crore now after Finance Act 2024. So after Finance Act 2024, we do not get exemption of more than 10 crore in 54 as well as 54F. Therefore, 10 crore you can claim exemption. Remaining 448 crore you can pay 20% tax. Okay, sorry, 12.5% tax. But Urvashi has one more option. You can write down in the examination because Urvashi is a resident. She has purchased land and building before 23rd July and she is selling land and building after 23rd July. So Urvashi also has one more option that don't take indexation and without indexation claim what? Claim 12.5%. Whatever is more claimed, don't take indexation. sorry, Urvashi has two options. Don't take indexation, take 12.5%, or take indexation and take 20%. Whichever is more beneficial, Urvashi can do that. So you can write that note. ICI has not asked, but you can write a note. Alternatively, Urvashi can do what? Has an option to take indexation by taking tax rate 20%. I hope it is clear to all of you. Next one is a case law question of Pradeep Kumar Malhotra. Very important case law which we have done in the chapter of IFOS under 222E. What is Pradeep Kumar Malhotra is doing over here? The name of the assessee in this question is Manju Menon. Manju Menon has 20% share in a private company. So Manju Menon has 20% share in a closely held company. Now, if that closely held company gives a loan to Manju Menon, that will amount to deemed dividend under 222E, because Manju Menon has shares of voting power of how much? 20% or more. Now, Manju Menon has done what? Manju Menon has given his immovable property and on rent to the company. In return, Manju Menon has also allowed the company to do what? To provide that property on collateral to the bank and take loan. So Manju has given what? Property on rent to the company. Now Manju has also allowed the company to give that property on collateral to the bank and take a loan. Now in return, the company is also doing some favor. See, Manju is doing so much favor to the company, so the company is also doing some favor. The company is giving an advance of 20 lakh rupees to Manju by passing a board resolution. So whether this 20 lakh rupees given to Manju will be subject to deemed dividend, and the answer is no, because this loan given by the company to Manju is not a gratuitous loan. It is not out of gratitude. Only gratuitous loans are covered under 222E. Now, it is not one-sided loan given by the company. Company is doing some favor on Manju. Manju is also doing some favor on company. 222E is not applicable. If only one-sided favor is done by the company on the shareholder by giving a loan, only then 222E is applicable. Otherwise, 222E is not applicable. I hope it is clear to all of you. And the third question in this particular question is on non-resident taxation and determination of residential status. Miles Company Inc. is incorporated in US. Their shareholders have met in India 3 times in the current year. 2 times they have come to India for modification of various classes of shares. It means they want to change the paid up capital from 10 rupees to 100 rupees, or 100 rupees to 10 rupees, or 10 rupees to 1 rupees. To change that, they have come to India, and one time they have come to India to sell some assets of the company. Majority of the board meetings, majority of the commercial and management decisions of the company are done in Chicago, USA only. Therefore, they are coming to India only for 2 small things. One is for sale of some assets of the company. One is to change the classes of the shares of the company. They are not coming to India for making management and commercial decision. Therefore, the poem of the company is outside India. Therefore, the residential status of the company is non-resident. Therefore, first we have to comment on the residential status. The residential status of the company is non-resident. Now, if it is a non-resident, we need to answer the following question. First, they are earning some dividend of 5,50,000 rupees net of TDS. From what? From GDR. Now, GDR dividends are covered in 115AC. It is taxable at 10% plus 4% surcharge, 4% cess, therefore 10.4%. But this is received. So, 5,50,000 is received, therefore this is net of TDS. Therefore, 89.6% is net of TDS, therefore 100% is how much you have to cross multiply. Because the word received and because the word net of TDS is very clearly written over here, therefore you have to gross up the dividend income. Second one, ICI has taken 2 views. First, very important point. Now, second is one is a very intelligent question. That foreign company, that non-resident foreign company is providing some services to Government of India. Which services? Technical services. Now, the government is going to use that service, is going to utilize the service where? The government is going to utilize the service in what? Utilize the service in Nepal. Whether it is deemed to accrue or rise in India? Yes, it is deemed to accrue or rise in India. When a government is paying royalty, FTS and interest, now it doesn't matter whether it is accrued in India or not, whether it is utilized in India or not. When a resident pays now royalty, FTS, etc., then we have to check whether the services are utilized in India or not. But when a government pays, the services can be utilized outside India also. So this is definitely taxable in India. Now, second thing, here also 5,55,000 is received. So you have to gross up. You have to gross up. But how much gross up? What should be the tax rate? Should I take this in 115A or should I take this in normal provision? See, that you have to take as a view, because in the question it is not written that the agreement is approved by central government. But agreement is not required. Approval is not required in case of central government. Now, in case of central government, approval is not required. That is also another catch. Always remember, when a non-resident provides services to a resident, then there is an agreement and approval, both are required to come under 115A. But when a non-resident provides services to government, only agreement is required. Approval is not required, because government cannot give approval to themselves. Now, therefore, even though approval is not there, still you can come under 115A. Again, I am saying, For government under 115A, approval is not required. Central government cannot give approval to itself. Therefore, without approval also you can come under 115A. So government can come in 115A. 2 points to be kept in mind out of this question. Government can come in 115A without approval also. Government can come in 115A even if the services are utilized by government outside India. Therefore, this is received amount. Net of TDS will be 20.8% will be TDS, 20% tax, 4% cess. Therefore, this 5,55,000 is nothing but it is 79.2%. 100% is how much? You have to cross multiply and find out the answer. I hope it is clear to all of you. Is it clear? Question number 3. Let's come to question number 3, which is on trust. Very simple question. Part 1. There is a trust, registered charitable trust under 12AB. Now they have applied 4,50,000 for the benefit of trustee. Gone. 115 BBI. You cannot pass unreasonable benefit to trustee specified person. 115 BBI flat 30% tax. Then another 2,50,000 you have provided as a benefit to Mr. Sujan Dave, who has donated 3,75,000 to the trust during the year. Now Mr. Sujan Dave will be called as substantial contributor. He is also covered in specified person. How, sir? Definition has been amended in the current year. If any person is contributing during the financial year more than 1 lakh rupees, or total aggregate contribution till date to the trust of more than 10 lakh rupees, both of them are considered to be specified person. So Mr. Sujan Dave is contributing 3,75,000 in the current year, so it is more than 1 lakh in the current year. So because it is more than 1 lakh in the current year, Mr. Sujan Dave is a specified person, substantial contributor. You cannot pass unreasonable benefit. You are giving a benefit of 2,50,000. This will also be subject to 30% tax. Third, you have accumulated some 2,50,000 last year under 11 subsection 2 to be used for specified purpose within 5 years. But in the current year, you are giving donation to another person. Again, it is a violation of 11 subsection 2. Therefore, 115 BBI will apply here also. You cannot accumulate the money and do what? You cannot accumulate the money and apply the money in the next year for donation purpose. That is also subject to what? 115 BBI. Check it, please. Part number 2. A trust was incorporated in 24. Now in 26, they are planning to make for an application for registration. In 24, they have not made an application for registration. Can they directly make an application for final registration, or they have to make a provisional registration? In such case, the trust can directly make an application for final registration. Provisional registration is only applicable if this is your first year of activity. Yes, if the trust would have come in 24 for making application now, in that case, they have to make a provisional application. Otherwise, if you are already an existing trust in 26, because your trust was started in 24, in 26 you are already an existing trust, you can directly make an application for final registration. The commissioner will give you registration within 6 months and you will enjoy the exemption from the next assessment year. You can enjoy it. I hope it is clear to all of you. Next one is a very simple question of DTAA. You can check it once. Very, very, very straightforward question. I am not wasting my time on that. Please check that at your end. Next question on TDS. The first question on TDS is on service charge, mandatory service charge which is collected by the hotel. I went to a hotel to eat something. The hotel has collected service charge paid to the employees. Whether the hotel is liable to deduct TDS on that, the answer is no. The Supreme Court in the case of ITC hotel has said that the hotel is not liable to deduct TDS on the tips which are given to the waiters or the employees of the hotel on behalf of the customers. That is not subject to TDS. Check it, please. Second, a partnership firm is selling some goods through an e-commerce operator of how much? 4,90,000. Out of which 4,30,000 is paid through e-commerce operator and 60,000 is directly paid by the customer to the seller. So both are subject to TDS under 194O. So there is an Amazon. I am Amazon. There is a seller. There is a buyer. The buyer is purchasing something. The Amazon is liable to deduct TDS of the seller. But if the buyer directly pays to the seller, then also TDS is applicable. It is deemed to be credited by the e-commerce operator only. In both the cases, 0.1% TDS will be applicable. I hope it is clear to all of you. Check it, please. On this 4,30,000 also 0.1%. On this 60,000 also directly paid by consumer to the seller, not paying through the e-commerce operator. Generally, what happens? The buyer pays to the e-commerce operator pays to the seller. 4,30,000. That is subject to TDS. Second, customer directly paid to the seller. That is also subject to TDS. It is deemed to be credited by the e-commerce operator. But sir, the total sale is 4,90,000. Are they not eligible for exemption up to 5 lakhs? No. Exemption up to 5 lakh is not applicable for firm. It is only applicable to individuals and HUFs. Okay. Only individuals and HUFs are subject to exemption if they provide PAN card or Aadhaar card. Otherwise, they are also not eligible for exemption. I hope it is clear to all of you. Next question is a very simple question on transfer pricing. Yalin Limited is located in country X, and that too they are located in notified jurisdictional area NJA, and Armo Limited is located in India. Now we are providing some goods to Yalin Limited in 11.75 crores. So Armo is in India, Yalin is in NJ, notified jurisdictional area. We are selling some goods to them at 11.75 crore rupees. Therefore, Armo and Yalin are deemed to be associated first of all, as per 94A. The transaction between Armo and Yalin is deemed to be international transaction. Transfer pricing is applicable. So now find out the arm's length price. So to third party, you sell the goods at how much? To third party, we sell the goods at 13 crores. But in this 13 crore, there are two things which are not there in 11.75 crores. Which two things? One is there is some insurance and freight of 25 lakhs. So you have to reduce that in this 13 crore. Insurance and freight is there. In this 11.75 crore, insurance and freight is not there. And there is some warranty of 0.19 lakhs, 0.19 crore, that is 19 lakh. That also you have to reduce. You will get your arm's length price as 12.75 lakhs. What is your actual price? 11.75 lakhs. Sir, shall I check 3% margin? No. For NJ people, 3% margin should not be checked. 3% margin is there now. If there are less than 6 items, then you have to check the 3% margin between your actual price and arm's length price. For NJ people, that is not there. For NJ people, safe harbor rule is also not applicable. If I am doing transaction with a person located in NJ, I am not allowed to do safe harbor rule also. So the arm's length price in this will be 12.56. Actual price is 11.75 crore. Differential amount should be added back. I hope it is clear to all of you. Next, case law. Case law. Question number 5 is generally case law only. They might ask one case law sometime 2, sometime 3 also. And then they will tell you attempt any 2 out of 3. Okay, most of them are the recent last 1 or 2 case laws, 26, 25, 24 case laws. If you do properly, high chances 1 or 2 questions will come from there only. Now, what is the first case law over here? Try to understand this case law, please. Very good case law. There is Air India over here. Air India is an assessee. Now, Air India has taken an engine on lease from a foreign company, which is from Germany. That foreign company does not have a P in India. That foreign company does not have a PAN also in India. But the DTAA between India and Germany says that the tax will be deducted at 10%. Now, the question is, because that DTAA says 10% and the non-resident does not have a PAN, should I deduct TDS at higher rate at 20%? As per 206AA, the court said that no. That higher rate of 20% in non-PAN cases should not be compared with DTAA rates. DTAA rates are final and conclusive from every angle. You cannot deduct more than 10% under any circumstance for DTAA. Yes, if this 10% would have been income tax rate, then you would have compared this with 20% and whichever is higher. But if this person is a 10% is a DTAA rate, you should not compare with 206AA DTAA rate. And therefore, in this case, the TDS will be deducted at 10% only, even though the non-resident foreign company does not have a PAN card. I hope it is clear to all of you. Second case law, very good case law. In this, ICAI has taken 2 views. 2 different case laws are applied over here. One is a Supreme Court judgment of Hindwire Limited and High Court judgment of Tony Electronics, and second is Supreme Court judgment of Elegantron Finance Limited and High Court judgment of ICICI Bank Limited. So this is a fight between 2 judgments. Both of them ICAI has given. ICAI said that you write whatever you want to write. Now, what is this actually, both the judgments? I'll tell you. I've explained all these things in class in great detail, obviously. The AOS passed an order on 20th of Jan, and in which assessee has made a mistake of reducing depreciation instead of adding. So instead of adding depreciation of 10 lakh, assessee has claimed depreciation of 10 lakh. It means they have claimed double deduction. They have claimed benefit of 20 lakhs. So who has done this? AO has not done this. Assessee has done this. Now AO did not correct this mistake. AO did not find this in the order. So try to understand the first paragraph. Assessment is done. Assessee has made one mistake of reducing depreciation instead of adding depreciation. AO did not found that. AO did not notice that particular mistake. Now, later on, assessee went to appeal for some other issue, not on depreciation. The appeal was finalized on 28th of Jan. The AO gave the effect to the appeal on 23rd of July. Now, the AO wants to rectify the mistake on 26th of June and is trying to rectify that double mistake. Now, the question is, what is the time limit to rectify a mistake? It is 4 years from the end of the financial year in which the order sought to be rectified was passed. The entire issue is from where the 4-year time limit will be counted, whether it should be counted from the original order or whether it should be counted from the rectified order or whether it should be counted from this appeal order. So there are 2 views over here. The Hindwire case law and the Tony Electronic case law says that the 4-year time limit should be counted from this subsequent order, not from the original order. But the ICICI Bank and Elegant Finance Limited case law said that no, 4-year time limit has to be counted from the original order. So if you follow Hindwire case law, then rectification is possible. But if you follow Elegant Finance or ICICI Bank, then 4-year time limit has gone. 4-year time limit has gone, and therefore you cannot rectify now in 2025-26 a 2020 order. I hope it is clear to all of you. And one last question in this case law is a very simple question. The SSE has deducted the TDS but failed to pay the TDS. Deduction has been done on time, but payment has not been done on time. Deduction has been done on time by the SSE, but the payment has been late. Now, in this case, what will happen? Pay attention, please. Whether the AO can impose 271C penalty? The answer is no. See, it is very clearly written in the law that 271C penalty is only for failure to deduct. It is not for failure to payment. Still, the deduction is done on time. Still, the AO is imposing 271C penalty for payment, and therefore, the AO is not correct. The Supreme Court has held that. 271C penalty is only for late deduction. It is not for late payment. I hope it is clear to all of you. Next question, question number 6. Now, from this question onwards, from this paper onwards, May 2024, because new course have started in May 2024. So, from May 2024 onwards, you will also start to see the questions on black money law and tax audit, because black money law has been included in the new course and tax audit has also been shifted from audit paper to your direct tax paper. So, very first question is on tax audit. So, there is a club, there is a travel company, Club U Travel Company. They have remitted huge amount outside India to Australia. They are saying that this is with respect to some travel. They are travel agencies, so they have to send money outside India because the passengers are traveling. Now, the income tax department has collected the information from the bank. They have collected form 15 CB, which is issued by chartered accountant. They have also collected list of passenger, copy of their passport, date of travel, date of when the invoice has been raised by the foreign party. The income tax department has done their homework. Income tax department has gone one step ahead. They have also verified from the passenger that whether you have traveled from Club U Private Limited. The passenger directly denied. The passenger said that we did not travel. Then income tax department came to know that all these invoices which were remitted outside India were for false reasons. It's a FEMA violation. Total 78 certificates were issued by 15 CB chartered accountant. 35 crores were remitted by chartered accountant by the company outside India, which chartered accountant has certified. Now the question is the chartered accountant guilty? The answer is yes, he is definitely guilty. When we asked question to the chartered accountant, the chartered accountant started giving an argument that he was not a statutory auditor and he has examined the books of accounts. He did not examine the books of accounts. He has just checked the KYC. He has verified the KYC. Because he was not a chartered accountant, he did not examine the books of accounts. What is the responsibility of chartered accountant when a chartered accountant issues form 15 CA, 15 CB? First of all, he should examine books of accounts. Even though he is not an auditor, statutory auditor, he should still examine the books of accounts. Second, he should examine whether the TDS has been deducted at proper rate or not. Third, he should verify the agreement between both the parties. All these things are not done. Only KYC has been checked. Therefore, a chartered accountant in this case is deemed to be guilty. See, all these points I am saying, you have to write down all these points in the examination, otherwise you will not get marks. That's the I'm not doing general discussion over here. I'm doing discussions over here which are very specific to exam which you are supposed to write. I should have easily said, nah, a chartered accountant is guilty, let's go ahead. No, I'm not doing that kind of revision over here. I'm trying to say everything minutely which you have to write in the examination. Therefore, you have to write down these 4 points, and then you have to write down, if you remember the clause, as per clause 7 and clause 8 of part 1 of second schedule, a chartered accountant is deemed to be guilty in this case. I hope it is clear to all of you. Next one, you need to identify whether the following persons are doing tax planning, tax management or tax evasion. So, Mr. D has a fixed deposit receipt with FDI of 50 lakh rupees. Now, he gifted this sum of 50 lakh rupees to his son. So, he gifted this FD to his son who is 18 years old, so that he can shift his interest income from his income to his son's income, because he is already earning lot of income. So, if I am earning already lot of income and if I make a fixed deposit in my name, I have to pay 30% tax on that. So, I am shifting that fixed deposit. I am gifting that fixed deposit to my major son. Is it tax planning, tax evasion? It's a tax planning. Most of you will say it's tax evasion, sir. There is nothing like tax evasion in this. Yeah, if I would have given this gift to my minor son, minor daughter, or to my wife, to my spouse, then it would have been clubbed in my hands. But if I give that to a major son, there is nothing wrong. I can give it to my major son, I can give it to my father, I can give it to my neighbor, I can give it to my girlfriend, I can give it to my boyfriend. It is allowed. There is nothing wrong. The law does not stop us. Therefore, it is allowed. There is nothing wrong. You can do that. Yes, if you trust your son, then you can do. If you don't trust your son, then don't do. As simple as that. Second one is very simple. Mr. Ram's annual income is 49.6 lakhs. Now he's about to receive some commission of 6 lakh rupees. So he's telling the company that don't give me commission, give it to my wife. My wife does not having any great income. So give that commission to my wife. This is clear tax evasion. Your commission, how can you shift to in your wife's name? You know that your income is already 49.5 lakhs. If you receive the commission of 5 lakhs or 6 lakhs again, then you will be liable for surcharge on total tax. So you are shifting your commission to your wife's name. That is absolutely tax evasion. This is clear case of tax evasion. And one last question in this paper is, there is a non-resident foreign company which is entering into a contract with several Indian company and they have made an application to BFAR. Now, suppose they are entering into contract with 10 Indian companies. So they want to know the tax planning, how much will be the tax liability. They want to know the tax effect. So for that purpose, they have made an application to BFAR. Now, suppose they have made an application to BFAR with 10 companies. Because they are entering into transaction with 10 companies. Now, one of the companies out of 10 companies has also made an application to AO to understand that same issue. So now the question is whether the application of the non-resident will be rejected because of that. See, one of the provision in BFAR is, if your application is already pending in front of income tax authority, then your BFAR application will be rejected. Now here ICAI has taken two views. That whose application, whether applicant's application should be pending or anybody's application can be pending, then you will reject the application of the applicant. So two views. View number one is correct view according to me. If my application is not pending, somebody else's application is pending, then you cannot reject. View number two. If anybody's application is pending, then also you can reject my application. Second view is very strange, very vague. First view is better. If my application is already pending in front of income tax authority, then you reject my BFAR application. But if somebody else has made an application, then you cannot reject my application. That view is correct according to me. You can write either of them, whatever you want to write. Okay. So this is what this paper is all about. So we'll stop here. We'll continue the discussion in the next session. 4 more papers and that will complete our 9 papers. Till then, bye all of you. Take care.